And that decision should be, first and foremost, to choose future over past. Your next step over the last one, choose your ideal world and start building.
Okay, let's get everyone back in the room. We're good. Did you try? So just say when people say 15 minutes and then say with my team, it's like, right, we're going to have a 5-minute toilet break and like, you know, half an hour later they're outside smoking. I'm like, which part of 5 minutes do we not understand?
He's over dramatic.
Well, you're the guilty party, are you?
I'm the goody two shoes that's there 1 minute before.
I set the alarm on my phone. I'm just like, we're busy, let's just get it done. Yes, I just heard about it recently.
Okay, cool.
But like a few days ago, Judy told me.
So let me answer some of the questions here for the people online. Alex, will you just tell people I'm going?
Yeah, we're getting started.
Some of the key takeaways was learn how to know how to do it properly. Okay, PE is key to improving returns and answering risk. And then Hassan said, would love to hear your thoughts on investing in Old Mutual, Alan Gray and Coronation. You trying to have me assassinated. Yeah, look, I think it's a very difficult conversation to have without kind of knowing the facts. But I would always say look at the numbers and compare apples with apples in terms of returns, in terms of fees. And then we're going to, in module 3, we are going to go through a family office. And I can safely say that from my experience, everyone that has experienced a family office is overwhelmed by, or not overwhelmed, overjoyed by the difference from what they previously experienced. So that would be my answer. Takeaway, learning from the experienced people and how to get results, enjoyable, and right, we really get going. Okay, so while we get everyone in the room, well, the light's different. Something's changed with the lights.
Switched off those bright lights.
Oh, is it?
We started seeing you cooking.
Is that, I'm fine. Is it better or worse with the screen?
That's
Is it better? Well, that's actually nice. So I don't sit looking at all of you in darkness, basically. Huh? Oh, no, don't worry, I'll take my face off. Don't worry about that.
I just want to make sure we put the pressure on. Now we can see you performing.
No, all good, all good, all good. Okay, so we got everyone in. Can we rock and roll?
Yeah, everyone that's on time.
Okay, so let's put that up so we don't have my face on large. Yes. I say this without being arrogant, but I have a master's degree cum laude in technology, but today is pushing my limits. It's like every piece of the puzzle. It's like, yeah, there, recording here, sound there, isn't loud enough. My word, this is, if it wasn't for Alex, Alex would just be like, good luck. Here the presentation is. Okay, just quickly, so to all of you in the room, fantastic to have you back, and to those of you online. Let's just quickly, any questions or any thoughts or any context that you'd like to kind of, because it's very important for me that we stay present and that we don't have something that's bugging us that would block us going into the next module. Does that make sense? Yes. So is there anything that I can help with, anything that I can answer, any questions I can answer in terms of where we're at? And again, I remind you that we agreed that we would go for the slightly longer version, and what I mean by that is that we can have this engagement. I don't just have to keep going, you know what I mean? So I will, and the other thing that I wanted to say, it's a big challenge for me, okay, is that I've got videos I want to play for you, okay? It's impossible, particularly in a live event, for me to get all the key partners to come to Pretoria and present. Like, it's never going to happen. Like, if you want to get access to the best partners, it ain't happening. So the only way for me to do it is we have pre-recorded sessions with them. The challenge we've got is that the best use of my time and your time is for us to be able to dialogue and talk, and I can give you a recording and you can go watch the recording. Does that make sense? So like down to Michael, as an example, it's a 17-minute video, and I think to myself, is it the best use of your time? No, but I've got a counter challenge, because I know that if I give you the recording, none of you are going to watch it. Because you'll go home on Sunday and you'll be busy, and You'll have to plant crops or something, and the point is you won't do it, okay? So what I'm going to do is I'm going to balance some of the videos, because I am going to play you videos, and it is hard for me to hold energy, particularly because that thing's not that loud. But some of them are extremely valuable for you to hear. Does that make sense, you know? So I'm going to balance videos and I'm going to kind of just use my intuition. So like Michael as an example where it's real people, real stories, I prefer, I mean, we've got real people in the room, let's have real conversations. Does that make sense, you know? But the videos I can play you, I mean, I think Michael's story is a lovely story to hear if you want in context around other people that have done it. Does that make sense?
Okay.
Yeah? Okay, so I want to start with a little video here then, as we pivot into module 2. And I love this video. We made this video many, many years ago, so you can see the, you know, what is it all about. And I love this video because for me, it sums up in simple terms what we do and how we do it. So it gives you a little bit of a context. Where the hell's it gone? There we are. So this is a little video we made a while ago, and the reason I'm just showing this right up front is because we've just gone through the why, and so a bunch of people might be sitting there going and feeling again that overwhelm. Okay, it's not possible. I don't know, or it's for other people, or I need lots of money, or I don't want more complexity in my life, or whatever it is. And so I like this. I'm choosing to play these little videos just to kind of give you a bit of peace of mind personally. So anyway, let's go.
Real estate. It's one of the most reliable and profitable investments in the world. 49% of the world's wealth is held in real estate. It's what built the wealth of kings and aristocrats. But investing in real estate, for the average person, is simply out of reach. It's a playground normally reserved for millionaires or billionaires. Only the top 0.1% of people own and invest in commercial real estate. There's a wealth gap across the globe that's pricing out the middle class from investing in one of the best ways to build and preserve wealth, which will enable them to give their children a better future. Studies prove that children who grow up in households who have stable financial futures do better in life. That's a fact. But too many people don't have access to it. We want to change that. Let's open up the opportunity to people who work hard, manage their finances wisely, and need a place to invest for their family's future. What we're doing at Wealth Migrate is exactly that. It's simple, but incredibly powerful. We're eliminating the typical barriers to entry when investing in real estate, whether that's knowledge, money, experience, or access. Access to what the top investors know and are able to invest in, but that you can't. We're giving people the opportunity to invest globally in commercial real estate through the internet, right alongside high-profile investors, and earn the same returns and monthly dividends. We're using the internet and our technology to give everyone access to real estate investment opportunities you've never had access to before. By giving you access to global real estate investing, our goal is to empower 1 billion people and close the wealth gap that currently exists. You don't need to invest huge amounts of money to become a part owner of a project. It levels the playing field and helps developers start new projects. It's a win-win for everyone. And then there's our technology, our secret sauce that helps you make smart investments. Now it's your time to grab this opportunity. Do it now with our trusted, secure real estate investment platform. Visit www.wealthmigrate.com to see what amazing opportunities are available right now.
What do you think? It's amazing when I see these videos, like with a little bit of humility and grace. You know, these videos were made like in 2015. As an example. Okay, some of them, and there's one I'm going to show you after lunch, so it was 2015. And it's taken us 10 years, literally 10 years to get here. But I'm super grateful that now everything I'm teaching and sharing with you is possible and accessible. It's 10 years ago I was teaching you these principles, but you had to fly to America with me. I just want to put that in perspective. And now you don't. like you can sit in Pretoria or in London.
Yeah.
Okay, so let's rock and roll, and let's go into module 2, which is all about the asset classes and the risk. So for me, this one, you know, there's lots of different asset classes, there's lots of different risks. So what do we need to know about them and what's important? Now, I remind you of the resources guide. Alex, could you do me a favor if we haven't done it already? Can we just pop the resources guide into the WhatsApp group, the workshop WhatsApp group for everyone, just so that they've got it. And I do remind you that for those online, Shane's always posting the little chats in there for you in terms of being able to go in and with the resources guide, etc. But yeah, again, if we just go back to that page, if you ever kind of get lost with the resources guide, Shane's put everything in there for you. So there's module 1. I just want to kind of show you again. So you go to module 1, there's your action steps. For those people that were a bit like me, that, you know, had to ask the person next to them for the crib notes, like these are the crib notes. Like, you know, there's the links to the groups to join, the strategy sheet, you know, it says sharing with a friend, it's all there basically, okay? Now we're going to module 2, and you've got the exact same thing. Okay, everything's here. So I just kind of want to give you the peace of mind that everything we're sharing, Shane's done an incredible job of making it easy for you, okay? Okay, joining the community. Now, this is where, I want to actually swear, but I suppose I shouldn't. I was about to say where shit gets real, but this is how I feel, because if we take our focus being globally diversified passive income and portfolio growth, and if we look now, this is the formula. So that's you know what we're aiming for, and this is how we do it. Does that make sense? We diversify across countries, currencies, assets, partners, and time. And then on the right is what we do. And I'm going to break this down for you, so you don't have to worry. I'm literally going to make this systematic and logical for you. But I mean, for the mastermind members specifically, if you take what we try and do as a group, that's it on one page. Like, there's the goal. Where's my pointer thing gone? Like, there's the goal up there. There. You know, that's the formula of what we're trying to achieve, or how we're trying to do it, and then that's what we do to get that goal.
To what Abdul was saying, that's measurable.
Yes.
You can actually track your progress. That's been my experience.
Yeah.
It's not just something that you do and hope to see a result somewhere in the future. You can actually track the
Correct. Correct, because I mean, as both of you are saying, if you don't track something, if you don't measure it, you won't achieve it. So that's been my experience. Yeah.
So what are mastermind members?
I'll explain later. Don't worry about it. It's our special. It's just our special people of unique. We really different. So.
Closed out. You refer to it all the time. I'm like, okay.
Not necessarily. Anyway, not necessarily. Not necessarily. But we'll. So just a quick one, and I'm going to do this in every module. Just a quick one. No financial advice I'm giving you. I'm not going to give you the whole spiel, but I'm sharing with you. Okay. Unfortunately, this is the legal part. We are in a regulated industry. Now that's good, because your money is part of a regulated thing, but equally I have to play by the regulations. And you know how much I love rules. That was a joke, by the way. So what I'm excited to share with you in this module 2 is we're going to go through a lot of the theory now of like how to choose the different assets, what the different assets are, what the different countries are. But to give you peace of mind, at the end of the session, I'm going to show you how you can earn a passive income in under 30 days, before Christmas. Is that cool? Okay, so even if you start with $10, so I just want to be clear, we're going to literally show you how you can do it step by step within 30 days and earn a passive income. Is that a fair challenge? Yeah. So that's what we're going to do. So, we met Jordan earlier. We looked at Jordan's needs. I hope that most of you resonate with their needs. Victoria and Victoria's needs. And that's the and that's the formula. Now, what I want to share with you is, and I can't do this. Some of you have done Wealth Going Global, which is a more intensive version of what we're doing now. So when I wrote this book, and when people, I told you already, 80% of people were losing money. The reason I wrote this book was I wanted it to be evergreen, and I wanted to say to people, listen, don't trust me, or don't listen to me, I don't care. But when you go and talk to the estate agent that's selling you a London property, just go and get the right information so that they can't feed you rubbish. Okay, now let me give you an example of rubbish. I'm just going to stop sharing. If I share, you see me on that screen though, don't you? I don't know how to do it. Anyway, what I was going to say, so I'll give you an example of wrong partners, wrong information. So a lot of South Africans bought properties from a guy, and I won't badmouth them. You can go look at my YouTube videos. But on a serious note, he sold to a lot of South Africans. And he was selling properties in America in 2010, 2011, 2012. And what was so interesting, he's buying these properties for $40,000 and he was selling them to South Africans for $80,000. And he was giving them a rental guarantee. So South Africans were like, wow, this is an amazing opportunity because I get a rental guarantee, etc. And this classic example of not the right information, not the right partners. So when I started doing America, he came up to me. I never ever had a problem with him, but he came up to me and he said, Scott, you're going to ruin the American market. And I never at the time realized what he was talking about. What he realized, well, what he meant was, I'm going to ruin it for him. But because I mean it sincerely, and I'm not being negative. When I started investigating his properties, in an example in Atlanta, so Atlanta is one of the biggest cities in America. He was selling properties. So if you got a street, on the left-hand side of the street, if you live this is like Cape Town now, by the way. If you live on the left-hand side, your kid can go to Saks or Rondebosch or whatever. But if you live on the right-hand side of the street, you're not in the right district, you can't go to the right school. Are you with me? So I went to look at one of the properties that he had sold to South African, but I took my partner on the ground to get the right information. I said, tell me about this house. He said, well, the problem is this house is in the third worst education district in the entire country. Not in Atlanta, in the entire country. And so the problem is that you and me go online and we do a Zillow search, which is like doing an online search for price. And this property is $80,000 and the one across the road is $120,000. So we're like, wow, we're getting a discount. The problem is that no one wants to live there, not a tenant, not a homeowner, because their kids can't go. In America, it's much more, your children go to the government system. Like, it doesn't make sense. So that's a classic example of the wrong information, and to be honest, the wrong partner. And you're starting to get the sense of what I'm trying to say. So what I want to share with you here, I don't have time today to go into this, but what I want to share, just to give you a context, is that if we take countries, currencies and assets, what I'm going to go through now, for residential, I want to quickly show you where to get the resources for residential. I don't have time, so in Wealth Going Global, I go into commercial and I go into other alternative assets, okay, in terms of the process. But I just wanted to share this with you. So I think this is pretty cool. So if you're wanting to go into countries and you want to uncover the global market, like where to invest. So I got a question, let's have some fun. I don't do this when I'm doing a webinar, but we're in a live room, so I'd love to know. So where do we invest? Do we invest in America, Japan, Brazil, Russia, Nigeria, South Africa? Like where? Where do we invest?
We normally just invest in what we know.
Okay, great. Yeah. So you 100% honesty, we invest in what we know. What else and where else do we invest and why?
America, because it's because besides what we know, it is well known.
Okay, so America,
And
yeah.
the dollar is, I don't know, what do they call it, the base currency?
Yeah, reserve currency, yeah.
Reserve currency.
Yeah. So fine, perfect. Anyone else? London, yeah. It's been probably the biggest place that people have invested in for the longest I've known people investing overseas. Very popular in South Africans, Dubai. But why do people invest, to be frank?
Get return.
Let's be honest, because your buddy did.
Yeah.
You're playing a bit of golf, just bought a house in London. I want to go get one. Where did you get that from? Am I right or wrong? No, come on, let's be honest. Okay? So it's like, so we get our information from our friends and family. And then what about the other problem is that, again, I've used this analogy, and I really wish this was not a true story, but it is. People go on rugby they literally go watch rugby. They watch England playing on the Saturday, and they watch us playing Scotland the following Saturday, and they've got nothing to do for 5 days, so they go look at a few properties and they buy one. Literally, I virtually guarantee you should know people that have done this. And so, do you think that estate agent's giving them the right information?
No.
I mean, they're literally telling them what they want to hear.
Yes.
Straight up, okay? So I'm playing a game here on purpose because for me it becomes down to, this is where you get to see the weird side of me. So investors want 100% clarity on the countries they wish to invest in and avoid 80% of the mistakes everyone else makes. So I went and I took Clem Santa's models, and this is a decade or more ago. And if you've seen or know, does anyone, just by the way, and I'm not being rude, does anyone not know who Clem Santa is? Do I need to explain him quickly? I don't mind if you don't, I'll just explain who he is quickly. Is everyone comfortable? Everyone knows? Okay, awesome. Okay, so in simple terms, I took all this scenario planning and I was like, well, there's no point in sitting here. I think I watched him for about 5 years in a row. I said, there's no point in sitting here for 5 years in a row, not actually being able to make a decision based on what he's saying. Because he's giving us the scenarios, and he's giving us the probabilities, and he's even giving us the flags. Yes or no? Yeah? But most people, literally everyone I know, says, okay, well that's lekker, but like my thing was, well, how do I use that? So I went and built a model, and I said, well, if you're investing, there are fundamentals to investing. Now, this one is more property focused, but with all due respect, there are fundamentals to all investing. Like nothing ever changes when it comes, what I've learned, okay, it's like the laws of nature, it's like gravity. If I drop this bottle, it's going to fall. When it comes to investing, there are true principles of investing that stand the test of time. They don't change. They are literally fundamentals. And so what I tried to do was build a model where we could go and get the information and put it into a system to help us, give us the right answers, not our gut feel, not our friends, not the local estate agent. Are you with me, basically? So if you take property as an example, or any investing for that matter, the first thing is if you're choosing a country, well, what about the economic risk? Like certain countries have more economic risk than others, okay? What about the value of a property discount? I mean, if you're buying anything, if you're buying property, you're buying a share, you're buying anything, you know, I think we all know you should buy it at a low value, not a high value. If it's overvalued, you've got a good chance of losing it, like value. Does that make sense? Yeah. Then in property fundamentals, two of the most important property fundamentals are population growth. So I learned this first from Dolph de Rist to give credit where it's due. Now, if you take Japan, do you know the property in Japan has never recovered since 1989? Never, not once. But another interesting stat, their population's gone from 120 million to 100 million. So if you don't have a population that's growing, you've got a problem. Okay, now that's at a country level, but it's also at a city level. So if you take Detroit, now back to my friend, we'll just call him Peter, that helped South Africans invest in America. He helped a lot of people invest in Detroit. Because again, it was like a wonderful opportunity. You could buy these properties at a massive discount until you did the research. 25% of Detroit is shut down. Yeah. They call it the Rust Belt for a reason. It's gone. Yeah. Like a 50% discount, if it never comes back, is not a discount. Yeah. That's good. I've tried to explain that to someone in Joburg recently. Anyway.
Just a question on that. If you've got population growth, how would aging population factor into it?
Sure. I think it's a very, because again, Clem talks a lot about aging population in Europe and England. Yeah. I mean, one of the jokes he said on one of our, and all of them in Italy, all of them in Europe. So one of the things that he said, which I love, is he said in England, if you put a roof on it, it's an old age home. So I think it's very material. Like it's important, you know, in terms of taking into account what's happening. Yep.
Yes, but so what about the GDP?
No, so I think that's taken into account here with the economic risk, the growth, in terms of where the country is from a growth perspective. Correct. Yeah.
So where did you get that measure from?
I'm about to show you.
Okay.
So then you've got supply and demand. So the single biggest principle I've learned in property is two things: population growth and supply and demand. I'll give you two examples of that. In America, when we had the last crash in 2008, there were 10 million homes that were sitting empty. So they overbuilt and 10 million homes were sitting in. We all heard fancy things like the GFC and what was that debt thing that they called it? What was that fancy debt thing that they...
The remortgaging.
Yeah, I can't believe this now, I can't remember. Anyway, there was those fancy loans they gave out and whatever. But in simple terms, they overbuilt. There were too many houses. In Ireland, which was one of the worst affected markets in Europe at the same time, 1 in 4 homes in Ireland sat empty. Yeah. Supply and demand, simple maths. Why is Cape Town property going up more than Joburg property? There's more buyers. It's that simple, and there's not enough supply. Do you understand the principle? And the last one, I know South Africans don't like this one, but it's called rule of law. Like if you actually own an asset, it's quite nice to be able to keep that asset. And then also if you have a tenant that's not paying, it's quite nice to kick them out because it's not fair. Okay? So you should take that into account. And I'll give you a good example of why this is really important, and I won't even make this about South Africa. India, in my opinion, is the most exciting country on the planet right now. Without a doubt, India is where we should be focusing in terms of business and economic growth. No doubt in my mind. But they don't have great rule of law. If you put a tenant in there, you can't get, it's very hard to kick a tenant out. So you've got, what's it called? I don't know, Noreen, if you can help me. You've got Indian where so firstly you can't buy in India unless you're a previous Indian resident. Like, so even if your grandparents came from India, you're allowed to buy. I as a non-Indian cannot buy in India as a residential property. Okay, it's called an NRI. And most of the NRIs I know, and by the way, I'm in Durban, and the biggest Indian population outside of India is in Durban. And most people that I know that have bought in India don't even rent their property out, they just keep it. Because you can't kick the tenant out. So that's why rule of law, so you might have massive economic opportunity, but rule of law is not so good. And what you do is you factor these all together, and it gives you a risk index. And then on the right-hand side, you've got a return. Now, by the way, some people might want to do 50-50 between income and capital growth. But my strong recommendation from watching some of the wealthiest people in the world is that they focus more on income than they do on capital growth. What I've learned is that middle class and professional people focus on capital growth. They buy a house in Pretoria, it goes up by R1 million, they tell all their mates how clever they are, but the fact it's costing them 10,000 Rand a month, they don't tell anyone that. I'm serious, okay? Or buy some crypto and, you know, I bought Bitcoin, it's flipping amazing, it's doubled in price, but it doesn't make me any money, so like there's nothing I can do about it. So it's got to, I'm not saying only income, that's why you've got to have capital growth. You want your assets to grow. I'm not being, but it's a balance. But you put the two together, and now you get a return index. And what's interesting is that you can literally plot those out. And to answer Judy's question, I'm going to show you where to get the research. But you can literally plot those out. Now, this was 10 years ago. I'm only using this because it's in the book, and I just wanted to share it with you. So again, Clem Santa helped me actually design this graph. So on the left-hand side, it's the same thing. You've got low return, high return, and at the bottom here, you've got low risk, high risk. And if you put it all into context, 10 years ago, the only place to invest in residential was America, because it was high return, low risk. And again, I just want to be very clear. This is not my opinion. It's not my friend's opinion. It's not my estate agent's opinion. It's literally what the facts tell us. Does that make sense? You know. Now, no one system is necessarily better than another system. I just want to be clear on that. But what's nice is if you use one system to compare three markets, it gives you much better information than if you're just trying to guess. Are you with me so far? In terms of that. So let's go and have a little bit of fun now and actually find out where to get that information. So I was up late last night.
Got you muted yourself.
Yep, sorry, thanks, I've done it. I don't know how I did that. Okay, so what I like about this graph is The Economist has gone back. So like in South Africa, we've got the deeds office. So it hasn't used my opinion or Derek's opinion, it's gone to the deeds office and it's literally taken the facts for as far back as a country can go. So the research goes back to 1970. All countries don't go back to 1970. It depends on how long they had a deeds office for. Does that make sense? And it's all of the top countries in the world. And you can literally go and compare them. So which two countries do you want to compare? Because the only downside to this is you can only compare if you look here at two countries at a time. So which two countries do we want to compare? I don't mind, any two countries, tell me two.
United States.
Huh? Where, sorry? United States, yeah?
India. Australia.
And India. Okay? Let's go. So, they don't have India. Interesting. Interesting. So, the only reason that they don't have India would be that the data didn't exist. Huh?
Ireland.
Okay, you want to go Ireland? Okay, cool. Okay, so we've got United States versus Ireland, okay? Just as an example, okay? So, what's fascinating here is if you look at real prices you can see, so just to be clear, you've got all the different countries here. And by the way, we're going to give you this link so you can go and have some fun, okay? So you can see the blue one that we're on, that is United States, and then the light blue one is Ireland. Okay, you're with me just in terms of it. So just to read this graph, what it's basically saying is you've got real prices, okay, and you can see that prices are since the year 2000. And by the way, you can see I can make it, you know, I can change it up and down. But in simple terms, American houses are 50% more expensive than they were in the year 2000, and Irish prices are 40% higher. Okay, in real terms. In nominal terms, which basically means that you take inflation. So real terms is where you minus inflation, whereas nominal terms are where you include inflation. In nominal terms, America's 130% higher and Ireland's 83% higher. Now, most people just sit there and they go, oh, well, that would make America a better place to invest because it's had more capital growth. I'm using the same mindset, you know, where people just look at it. But actually what's important is income. Because when prices go up, if the value, like if the average income in a country is X and house prices are really high, the chances of house prices going up anymore are quite, they can't, because people can't afford to pay more. Does that make sense? So what becomes really important is to look at the income of a property. So if you look here, and if you look on the right-hand side here, you can see that America, so Ireland looked really good, but now look at how unaffordable houses are in Ireland. I know it's quite small on the right there, but can you see over there, if I use this pointer, there, you see how Ireland has become a lot less affordable because of the spike in prices. Like, prices have gone up a lot. And then the last part that's really, and by the way, you can see here, according to valuations, America's 6% overvalued and Ireland's 7% overvalued. And then finally, the one that I think is important for us as investors is how much income am I getting out of my asset? Now, whether I'm buying a house or commercial building or stock on the stock market, how much income am I getting? So if you look at income, again, you can see there, but basically America's 15% overvalued and Ireland is 11% overvalued. So, I mean, you can literally go through this and you can play around. So back to your question, Judy. Those numbers, if I pull up, so let me just pull up the calculator here. Where am I going to go? So I redid this when I did Wealth Going Global. Come on. So just 2 seconds, I want to find you the... There. That's so weird. I can't bloody find the thing.
Use the hourglass search bar.
Yeah, I just, weird, I don't know why I can't see it yet. It's so bizarre. All my calculators here, and I don't know where the hell it's gone. Anyway, I'll come back to it. I'll find it in the break then. Just want to see one last time if I can't see it yet. Anyway, in simple terms, if you go back to this, when I used 15%, so you remember America was 15% overvalued, I would then use 15% there. Are you with me so far? So like you would go through, and what we've got in the resources page is we literally teach people where to go and get all the information. So if you want to go to England as an example, Academimetrics is the best place to research for all of the data for England. There's 7 different indices, but the best one's Academimetrics, because again, it's off the Deeds office. If you want to go to Australia, you would basically go to Core Logic, so it's the S&P Core Logic. We'll give you all these links basically. If you want to go to America, it's the Case-Shiller, so it's also owned by S&P, it's Case-Shiller. And by the way, if you want to go to South Africa, it's the Property Barometer, the F&D Property Barometer. So all of these things exist. And just by the way, how cool is this as well? If you want to choose like which city to invest in, you can literally choose between London and New York and whatever. You can do exactly the same thing. Can you see how much more empowered you would be with this information, this versus just, hey, like where should I invest next? Does that make sense, you know? So
that's basically the decision you make for us.
I'm going to teach you how yes, yeah.
When you find an opportunity.
Correct, yeah. Yeah, so I'm going to show you how we use this. I'm just giving it as a gift. Whether you want to use it yourself, perfect, we'll give you the links as well. Does that make sense, you know? I think, you know, it's a great question. I don't want to overwhelm people. Like Susanna's online and she always goes, Scott, don't show all this to people. They're bloody scared and they'll run away. Okay. and I'm like, no, but I believe people should understand the substance. Whether they want to do it all, like literally we're saying 2 options. Go and do it all yourself, and here's the calculators, here's the research, we even give you the links, like go and do it. Or partner with us and we'll do it with you and we'll help make the best decisions. Does that make sense, you know, in terms of that process? So when we do the property going global, the wealth going global course, I literally showed people where to find the economic risk, where to find, you know, all of these stats, including rule of law, everything, like literally so that you could go do it all yourself if you wanted to, in terms of that process. Okay, and then this comes to your question, which is that we then built in 2014, we built GIDS, which is our global investment due diligence system. And it really took the principles of what we had in this book, and we expanded upon it, because now we got into commercial property and we got into other alternative assets. And if you look at it, there's effectively 10 layers. So you've got to start off with like, which currencies should we be looking at? Which countries should we be looking at? How do you structure the system, you know, in terms of actually investing? Which partners? How do you find the partners? Which cities? You know, just in my interest, okay? So we all say, yep, let's go to America. Do you know there's 300 cities in America? 300. They're called MSAs, Metropolitan Statistical Areas. Okay, like which one where do you even start, you know, in terms of that process? And then it's a case of, you know, once you've found the city and whatever, now you've got to do an analysis on the deal. Like, does this deal make sense? Then there's due diligence, like on that deal, etc. Then there's actually running the deal and managing the deal, etc. So answering your question, I actually forgot that slide was next. It literally sums up your question perfectly, because that's the system that we built to help make these decisions. So that's how we look at the different countries, etc. If you go currencies, I don't do it on my own. That's where chapter 2 of the book and module 2 of Wealth Going Global is done by James Painter. And we literally help investors diversify their portfolio and mitigate risks by investing in multiple different currencies. So just before I go to currencies, I wanted to show you something pretty cool. So when you do the course, and I'm just going to go into the course here. I need to sign in. Just give me 2 seconds. Come on. Okay, so when I go to my countries, and basically, like I can go through, I can get the content, but then all the materials that I just said to you, they're all here, like everything's here. I know it looks like a shitload of stuff, but the point is it's there if you want it. And then you can go and choose your top 5 countries. So you literally go through and you can choose your top 5 countries. So if you want to, I did this about a year ago. So I looked up data, sort of, I'll be doing it again in the next couple of months. But like in residential, commercial, and alternative assets, according to the data, and again, I'm not giving you financial advice, I'm just telling you what the data was showing me. Those were the countries to be looking at in residential, commercial, and alternative assets. Interesting, eh? So I'm now trying to help you understand the substance of how I did that, in terms of that logic, basically. Okay. In terms of currency, how do we help people diversify their portfolio and mitigate risk by investing in multiple currencies? So this is where we built the Global Wealth Index. So I'm sure most of you have heard of CPI, like that's how they manage inflation. And the way they do inflation is they literally take a basket of goods and they say, well, if we chuck in the essentials people need, how much does it cost today and how much does it cost in a month or a year? And that's how they work on inflation. So I said, well, why don't we create the Global Wealth Index where we can compare our buying power? So Judy mentioned that we lose 5% a year on average against the dollar. What does that mean? Like for us as South Africans, what does that actually mean? And by the way, it's not just South Africans, it could be anywhere in the world. So I decided to create the Global Wealth Index, and my logic was, if you want to be a global citizen, like if you really want true freedom of choice, let's choose a basket of goods that could sum that up, okay? So I said a family holiday to Disney World, a family holiday to go skiing in France, a private school in Australia, sending your kid to Harvard, and or immigrating to Australia or America. And you'll notice what I did there very intentionally. There was a bit of England, there was a bit of Europe, there was a bit of American dollar, there was a bit of Aussie on purpose, and kind of just, it doesn't actually matter what the basket is if you think about it. It really doesn't matter. It's just comparing the same basket over and over again. And so, I don't know if you can see here, that thing's not hugely clear, but in simple terms, if you take 1983, 1993, 2003, 2013, 2023, we've lost 92% of our buying power against the dollar over that time. So that's when Judy says we're losing 5% a year, our buying power, we've lost 92%. Now, the beauty with the Global Wealth Index is not a South African thing. You can take any 2 currencies. You could put the Singapore dollar against the US dollar, same basket of goods. You could just, so it's not difficult to do. So it allows anyone anywhere in the world to say, okay, well, what does this actually mean to me and which currencies should I be looking at? And then what James Painter does, which he's really the best I've found, is he goes and teaches people, like, what is the hidden engine behind the markets? Why do currencies go up and down? And then, why do exchange rates adjust? Like, what is the... So I'm not going to go into all the detail today, because I'm showing you where to get the information if you want it. Does that make sense, But in simple terms, it's things like productivity is very important, like in terms of one country over another country's productivity, etc. Inflation, inflation, I've already mentioned that too. And then the biggest one is actually sentiment. Like people's sentiment as to whether, and that's all trackable. So he literally teaches people how to do that. And I'm not sure, there was something wrong with my login last night, because I did pre-prepare for this, and he was in America. So I sent him a message, said, dude, there's something wrong with my login. So let's just see if I can log in here quickly. No, he hasn't updated me. But anyway, long story short, you get these reports. Now again, back to your question, like this stuff, most people are like, I don't know what this is, and they want to run away, okay? But what's important is we don't care about where the rand's going against the dollar in the next couple of days. Because when you're buying a commercial property, you're thinking like with 5 years. Does it make sense? We're not day traders. I don't actually care whether the rand's going up or down between now and Christmas. What I care about is what is going to happen with my investments in 5 years. Are you with me, basically? So what you can look at is like long-term trends and like where things are going. And what James teaches people is like, right, which currencies to use. And by the way, if you're into this and you want to go and do it all, he's given people a 14-day trial to use the system, a free trial. Okay? Now, I just want to come back to the question, because it's such an important question. You don't have to do this all yourself. Do you remember how we started, like back 3 hours ago or however long ago it was? I promised you I'd give you the information, but I also told you I'll show you the partners you can do it with. Does that make sense? Okay. Yes. But I believe it's very important that at some level you've got a background understanding of what's going on and how it's happening. Does that make sense? Okay. Right, the next one, module 3, assets. This is the one I always enjoy the most. So, building your global portfolio, selecting the right assets for your investment. We help investors understand the top... Oh wait, sorry, I made the same mistake again. let's go back here quickly, and let's go back to the course. And if you go down to currencies, and you go your top 5 currencies, according to the research from James, we needed to be, and again, albeit this was about a year ago, but I don't think it's changed hugely. You've got the US dollar, the euro, the pound, the Aussie dollar, and Bitcoin. The 5 currencies that the trends and the graphs were showing to be in. Yeah?
So we could see that having our money in South Africa is not great because it devalues so much, but we're only allowed to take so much out at a time. So how do we negate that?
Where there's a will, there's a way. No, you're 100% correct. I mean, it's R1 million discretionary and 10 million rand per person, and you know, I understand all this.
My kids are
But you know, it's nowadays with you know, because a husband and wife can do 10 million each, and any kid over 18 can do another 10 million. So it doesn't you know, for most people that's not a challenge. And then interesting enough, back to the mastermind family office level, there's always ways to do it in a legal way, you know, to be able to do it. So it's not a constraint in terms of doing it. It's a frustration, and it's the same frustration India has and China and everywhere else. But it doesn't have to stop you. Does that make sense? Okay. I'm giving you the cheat sheets here. I should make you go do all the homework on your own. Okay, asset classes. So I'm just going to go through this quickly. We could spend hours on this. Hours and hours and hours on this, okay? But the 15 most commonly recognized asset classes, according to ChatGPT, are stocks and equities, bonds, real estate. Just by the way, I assume okay, I'm not going to assume. Bond equities are where you invest in companies through the stock market. Bonds are where you issue debt to governments, municipalities, and corporations. Just by the way, how many governments do you know are like in good standing and running their businesses well? Okay, but you're happy to lend the money. Real estate, properties, residential, commercial, industrial, etc. Cash, I think that's self-explanatory. Commodities, gold, silver, oil, gas, wheat, you know, etc. Mutual funds. So I've spoken a bit about mutual funds. This is where pooled funds from multiple investors used to invest in various securities. So it's basically spray and pray. I don't know how to say it any other way. Exchange traded funds. This is the easiest way to invest in the stock market. It's the safest, well, maybe not the safest, but certainly the most cost-effective way to invest. And I've got a partner, Ann Wilson, who, if you want to go and learn from her, she's the best I've found anywhere to teach you on how to do. I know you guys have done it with Ann. So, yeah. Then derivatives, financial contracts derived from underlying assets such as options, futures, and swaps. Alex wants to do this. I've got I don't even know what this means. Like, I'm serious. Like, currencies, I think we all understand what that is. Private equity. So this is ownership in private companies. So it's where it's not on a stock market, it's a private company. Hedge funds, investment vehicles that pool capital for accredited investors to employ various investment strategies. So again, it's a sophisticated fund. Venture capital, it's where you invest in early stage companies with high growth. Arts and collectibles, you buy artwork, antiques, rare coins, cars, stamps, whatever. Cryptocurrencies, and then infrastructure, where you invest in transportation, energy, utilities. So those are like the 15 kind of, apparently, according to ChatGPT, the most recognized assets. So what's interesting, just my interest, who knows the difference between primary and secondary markets? Anyone? No? Okay, so this is quite an important thing. So the secondary market is the stock market. So it's where you buy shares, you sell shares. It's the stock market. It's the secondary market. The primary market is this. It's this building. You can't buy or sell this building on the stock market. Are you with me? It's investing in a private company. It's buying gold. It's buying cryptocurrency. So the primary market is stuff that's not tradable on the stock market. Are you with me so far? Now we're going to talk in the next module about asset allocation. And more than 50% of the wealthiest peoples in the world is going into primary market investments. And yet most of us have the majority of our investments in the secondary market. Are you with me?
Yeah.
So I can go into this in a lot more detail, but in simple terms, that's the difference between the two. And all of us, oh, and by the way, back to what I said earlier, the financial industry's only figured out how to make money out of the secondary market. So what Abdul said, firstly, it's hard to access the primary market, and secondly, they haven't figured out how to make money out of it, which is why you're not offered it. Fact. Well, if I'm wrong, then why don't they do it? Okay, quickly, why no residential? This one frustrates people. This is especially for you. That conversation we just had. Yeah, this next 5 minutes is especially for you. Okay. So I've been doing this 28 years and helped about 2,500 people buy houses or apartments. And this is the lesson I learned over time. And in simple terms, there's me and you over here, and we're an investor, and we want to buy a house. There's 16 different middlemen between us and our house. Okay? I'm being kind only with 4 on the screen, but there's actually 16. And there's very little trust in the system, there's no transparency, and because of the high fees, there's not a lot of alignment and results. And again, this is that point where when people argue with me and they disagree with me, I go, listen, I'm sorry if you hate me, but the facts are the same. Only 1% of people retire wealthy, and the majority of us invest in residential houses. Like, it's a fact. We can't argue the facts. Does that make sense? So when we look at this, now you go a little bit further and you go, okay, well, what is this myth? Okay, well, how many people do you know that literally say, okay, but I'm going to diversify. I went to London, I bought a house. Like say to themselves, okay, but I've diversified now. I've got an apartment in London or whatever it is. And the challenge is, if you look at the value chain of real estate, there's actually a value here. So there's multiple steps, but the big steps are there's land zoning. So I love the fact in this area, most people know what I'm talking about. For years, you drove from Joburg to Pretoria where there was nothing. It was just a big farm, okay? And then what they did with Atterbury is he went and got the rights to turn it from a farm, which is greenfield, into brownfield, so that you could build. So that's what land zoning is, okay? So the value goes up tremendously when the farm gets turned into something you can build on. You with me? You with me? Stage 1. Stage 2 is you're the developer. You actually have to build something. So Atterbury built the Mall of Africa and like whatever, but they had to build something. Stage 3 is someone has to own that building. Now, whether it's a house or a commercial building, you've got an investor that owns it. Are you with me so far? Stage 4 is where it gets sold to a fund or a REIT, and then it gets put on the stock market, and then you and I come along and invest. That's the way it works. Okay, I'm serious. Okay, so if you look at the returns, and it depends, it fluctuates around the world. And this is IRR, internal rate of return. But in simple terms, don't get caught up on the numbers and the thing. A land developer is looking for a return of about 30% a year, and a developer is looking for 25%, and an investor is looking for about 20%. A fund or a REIT, when you invest in a pension fund, if you invest in Old Mutual, and you pay what are you asking for your pension when you get to 65? What do you want out of them? What do you want out of, you pay your pension, what do you want when you get to 65?
More than better than inflation.
You want better inflation, but let's just simplify it completely. You want income.
Yeah.
You just want them to pay you. Yes or no?
Yes.
So they buy income. That's what they do. It's called stabilized income. So they buy stabilized income. So they buy on an income. So they're looking at a return of like 5 to 8%. And then you and I come along and we're wondering why we're battling to beat inflation. So that's the value chain of real estate. And if you want to, you can go read this article in Business Day. It's on my LinkedIn. You can go look me up on LinkedIn. It's Robosis and the Billion Group. And what was really interesting is that the Billion Group was the developer, and they built a whole bunch of shopping malls here in South Africa. And then they put tenants in them. And then 3 years later, they sold them to a fund called Robosis. And they listed them on the Joburg Stock Exchange. And then all you and I invested in that through our financial advisors. The problem was that Robosis and Billion were the same person, owned by the same company. Okay, and in this article, not my opinion, I'm not being horrible. This is the Business Day. They went on to say like how overvalued these shopping centres were when they got sold to the fund, and then you and I invested in this overvalued asset. Now, the single biggest way to make money in property, does anyone know the single biggest way to make money in property? I know most of us, we've been taught things like buy low, buy from a motivated seller, all of that stuff. It's important, those are all right. But the single biggest way I've watched people make money in property is that you build something that's of value that a property fund wants to buy. That's where all the money is made. So you build an asset with stabilized income and you sell it to Old Mutual. Are you with me? Are you with me? Like, because that's where the massive value, because they're buying the stabilized income and you're selling all the value. You're getting all the value out. That's how it works. Everywhere in the world, that's how it works. So the question I always have for people is, if that's the case, and if you're here and you got these middlemen over here, why don't you just go right up, like why didn't you become, why don't you own that KPMG building right next to the Mall of Africa? And or why don't you build the whole of, what's this estate called? That big estate, Waterfall Estate. Why didn't you do it all yourself? And again, we all know that it's everything from, how do I protect myself? It sounds too good to be true. I don't know how. Too much compliance, scams, access to partners, difficult, ongoing management. Time and effort, too complicated. I mean, we could put another 100 up here. But I always say there's three things. If I've done this in 178 countries. There's three things that come through over and over again. I don't have the time, I don't have the money, and I don't have the knowledge. Literally, like those are always generally the three things as to why people don't do it. And I love using this metaphor because we all understand it. And this story is specifically for you. But like, seriously, if you took Uber, okay, before Uber, so how many of you had a private driver in 2005? Just personal driver that drove you around. So we've got one, perfect. one person. No. Your parents. But in seriousness, before Uber arrived, virtually no one had a private driver. It was for the exclusivity of the top 1% of the top 1%. Yes or no? Okay. And in the old days, if I arrived at Heathrow Airport or OOTAM, it doesn't matter, I would have phoned a taxi owner association, would have phoned a taxi owner, and then the driver would have come out to get me. And if I didn't know my way around London or Joburg, they would take me the long way and overcharge me. It was a horrible experience. And if I lost my phone, I'd never ever see it again. I mean, we were gone. Like it was. And then suddenly Uber comes along, and as long as I got a smartphone, I've got access to having my own private driver. I literally we did it yesterday. It takes 7 minutes, boom, 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 picked up, straight to our destination, sorted. Okay. And I mean, this picture here was a friend of mine where he left his phone in the car, and I want to take a picture because it sums up the fact that you can also, even if there's a problem, you can get the problem fixed because there's transparency and you know what's going on. So if you think about it, what has technology done here? It's cut out the middleman. You're getting directly in contact with the driver. It's cut out the costs. Like there's not all these costs all the way through the process. I mean, it's 100, I don't know how much times, but it's 100 times cheaper than having your own private driver. It also has increased the trust. I mean, how often do you see a lady driving Uber? Okay? Fact, okay? Transparency, you know where you're going, you know you've gone the right route, you know they've took you the quickest route. And accessibility. Every single one of us now has a private driver.
And language, like when you travel. Like you can use Uber in Egypt.
Exactly the point. So you can use Uber anywhere in the world. So not only do you have a private driver in Johannesburg, but you've got a private driver anywhere in the world. So using that metaphor, what did Uber do? They just literally cut out the middlemen and they helped us go up the value chain. So what we do is we literally help people go up the value chain and invest in income producing assets, and we help them invest in development assets. Does that make sense? I mean, you invested in Manhattan, didn't you? Yeah, I'm just saying you and I. I mean, we invested, I'm going to show you this now, but we invested in Manhattan. Did you? I don't know if anyone else did. So the three of us, I don't know, Judy, if you did.
No.
Okay, tough for Judy. She didn't invest in Manhattan. But like, we invested in a development in Manhattan in December last year. Like literally in Manhattan, New York. Okay, that's an example of what, and you know, I invested, like I did it on purpose. I invested $10. My one transaction was $10, just to prove that I could invest in Manhattan from $10. I'm just kind of keep trying to reinforce how this is possible. Does that make sense in terms of what's happening? Okay, what don't we do? Because you know what's important in life is not only what you do, but what you don't do. We don't look at assets where you have to pay an expert. So what I mean by that is that if it's too complicated to understand and you've got to go and pay some very clever analyst to come and give you a 400-page report, like, there's a problem. The second thing is that I don't generally like to look at assets that have no income unless it's part of timing. So like, you've got to be careful. Like there's an opportunity on our platform right now that's a private equity opportunity where it's only got 5% income, but it's got quite high growth potential, okay? So if you balance your portfolio, I'm not saying no income, I'm just saying be careful, it's not only all capital growth. Like, does that make sense, you know? Assets which are short-term, volatile, high maintenance. So I'm not bad-mouthing day trading, I'm not bad-mouthing cryptocurrency, bot trading, I'm not bad-mouthing any of that stuff. But what I don't want to do is, while we were having this conversation, I lose 30% of my portfolio because I wasn't checking my phone. I'm serious. There's a big, big difference between, having to check every 3 minutes and is it going up, is it going down, and oh, don't worry, and I know you'll be told, don't worry, we can put I can't even speak the fancy language, but we put the stop prices and all that. Come on, let's be frank, it's very active, in terms of that process. Assets I don't understand, so derivatives as a good example. I don't get it, like, in terms of, so it's just better just not to do it. Assets which are mom and pops. Now, I apologize for the term, but it's the truth, is that we've all been taught like how to invest, and it's a very kind of mom and pop retail way to do it. So my logic is, if I'm going to invest in London, I'd like to be outside of what the mom and pops are doing, because the mom and pops is massively overcrowded. Everyone's running around, going on a property course, running out and trying to be a property investor in London or in Johannesburg. Okay? And so do you think it's a crowded market, yes or no? Everyone's doing the same thing. So just step out of the crowd and play where the institutions are playing. And then even better still, we like to play in the market where it's too small for the institutions but too big for the mom and pops. So that's not even it's like a middle market. Does that make sense? I mean, Judy showed me an opportunity yesterday that I didn't even know existed in South Africa, where this company's built 500 homes. They own all 500 and they're renting them all out. Now, that's the difference between institutional investing and mom and pop investing. They've got everything, like they'll have, I promise you, they'll have all the maintenance teams and everything, all running, okay? And the difference is all of us have been trained to go out and buy a house. We've got to manage the house, then the bloody roof breaks and we've got to send our husband to go fix it, or he fights and then we've got to get the whatever. You get like, there's shit involved in maintenance and running and owning a house, like, I'm sorry, but we all know what I'm talking about. Okay, if you've ever owned a house, you know what I'm talking about. Assets where you don't get the right information. So that's a really important one, because if you can't get the right information, then you probably shouldn't be doing it. And then assets where you can't get the right partners. So I'll give you a good example of this right now. I want to be in data centers. Okay, I could talk to you for 2 hours about data centers if you really want me to. I've been trying, for the mastermind members, they'll know I've been talking about this for a year. I mean, I'll find a partner. So we could go do a data center tomorrow morning. I mean, anyone can just find a data center, go on LinkedIn, but like, how do we find the partners we can trust? Because I don't know about you, but I don't know how to run a data center. So if it doesn't go well, I can't arrive and start programming to fix the bloody thing. Like, so I've got to find the partners that I can trust, that have the track record. Are you with me as to how it works? And then the last one is assets in countries we don't understand. So this one's quite an important one. Like I told you, I want to be in India. I've been trying to be in India since 2017. But as a country, it's a very difficult country to understand. And I'm not even going to go into Vietnam as an example. So if you look at any economic analysis, Vietnam and Southeast Asia is another place to be. But I mean, I've been on holiday there and it's hard to buy lunch. I'm serious. Like, I was in China in 2003. In Shanghai, I specifically went there to buy property in 2003, and I wish I had bought property, but in hindsight, I even know that even then I would have been scammed, okay? Because what I mean by that was, I mean, property in Shanghai has gone up, it's quadrupled, it's gone up 4 times since I was there. But I battled to buy a plane ticket to fly from Shanghai to Bangkok. No, honestly, in those days, if you went to China, no one spoke English. Like it was, I literally, the way I solved it in the end was I went to a map, and because they all called different names, that's all. I went, I need to go from here to here. No, how? You know what I mean? Like, and I literally, they was trying to buy a plane ticket. And I was like, how the hell do I think I'm ever going to buy property? Do you understand what I'm trying to say here around that? Anyway, so that's, like those are the 8 golden rules I would say are not to do something, okay? And I would learn them, copy them, you know, whatever, take a picture of them. And what I learned actually from Ray Dalio, which I'll give him respect, is he talks about his principles. And when you make mistakes, try create principles that you stop making mistakes, if that makes sense. So like those are 8 of them that we come up with to stop making mistakes. So if you take those principles, we don't do stocks, we don't do bonds, we don't do cash. We're not saying you shouldn't do cash, we just don't do it. Put it in your bank account, you don't need us. We don't do mutual funds, we don't do derivatives, we don't do currencies. We do real estate, we do commodities, and we do ETFs. Now, just to be clear, we personally don't do ETFs, but like our partners do ETFs, our family office does ETFs, and if you want to do them privately, Ann Wilson can teach you how to do ETFs. But I do think you should be in ETFs. Private equity, we do venture capital, cryptocurrencies, and infrastructure. We don't do art and collectibles as much as Alex wants us to do it. And again, art and collectibles is less a case. I know there's another mastermind lady in Italy that has someone that does fine whiskies in England. Like, I'm gonna talk to them. I've actually just been too busy. The only reason we don't do art and collectibles at the moment, we just don't have partners. I think what I know about art and collectibles is embarrassing. So, I mean, you could literally sell me my son's painting as a Picasso and I wouldn't know the difference. Like, so, again, it comes back to partners. And then hedge funds, I've got no idea. So, what do we focus on? Commercial real estate, multifamily. So, by the way, multifamily in America is where you own like 500 to 600 units. So you don't own one apartment, you own 600 apartments. And you've got the management team, the maintenance team, and everything. Now, some people will think this is residential because it's houses and apartments. But it's not. It's a commercial institutional asset. The banks see it like that. By the way, in America, the way that they work it out is 4 properties or more. 4 and below is mom and pop residential, and 5 and above is commercial. That's how the banks look at it from a debt perspective. And that's why, Judy, I was so impressed, because I've never seen this in South Africa. So what you showed me yesterday is multifamily. Industrial, so again, you know, with the whole rise of e-commerce and, you know, industrial logistics, MOB, which is medical office buildings, so in the whole medical space, office, so as much as office is out of favor in the middle of Sandton or the middle of New York, there's still places that people need to work and go, so you've got to be in the right places. Co-living, which is it's an upscale student living, but it's basically where the millennials are living, and it's been one of the fastest growing assets in America, England, and Europe, and it's growing in Australia as well. London residential, I'm going to share with you a video about this. So you can still be in London residential, but do it large scale. First mortgage debt. So this product debt is where you effectively are competing with the bank. So in the old days, people only went to the bank, but the banks are so difficult now with so much red tape that you effectively provide money as debt leveraged against the property, just like the banks did. Does it make sense? Mm-hmm. One of the fastest growing asset classes in the world. Retail. So, you know, things that I like in retail are like convenience, and, you know, all of us still need to go to the shops, certain shops, like, you know, the things that e-commerce can't kill. Senior living and aged care, there's your one, Judy, for the aging population. And then mixed use, which is where you kind of got properties that have the mixed use component. On the other side of the fence, and data centers. Just a quick headline on data centers. So we all use computers, we all know about AI, we all know about cryptocurrency, big data, and all these fancy terms. The way to build data centers is very difficult because they take so much electricity. So the supply of data centers is really hard, and the demand is doubling every 6 months. Like, it's a simple equation to see that there's an opportunity there. Mm-hmm. And if you've ever heard of that, you must have heard of the saying, in a gold rush, like, what's the best thing to do in a gold rush? Don't go mine for gold, sell the spades. My attitude is like, how the hell do I choose between Facebook or Amazon or the next cryptocurrency? tell you what, why don't we just own the data center? Because we all have to use the data center. Like, do you get the point?
In Australia, there was one company just won an award for using baby oil to keep their computers in because it uses a fraction of the electricity.
Oh, really?
Yeah. In Perth, they just won an award because the data center's using so much power, but if they keep their, sorry, I'm not a tech person, they serve it into this like baby oil, they called it, they use literally a fraction.
I can't remember the stats, so don't quote me exactly.
And so it's Perth, funny enough, is becoming one of the data center hubs
Oh, really?
because of this new technology.
Oh, wow, okay.
That's all
No,
I
so,
know.
I mean, the stat was something ridiculous, like the average data center uses the same electricity in 1 month as 150,000 homes use in a year. And so, like, if you're the average politician, good luck passing that and getting re-elected. You know what I mean? So anyway, so I don't have time to go into every one of these asset classes, but it's one that if I could have invested in that this year, I would have. And I've tried really hard, and we are trying really hard to find partners.
That's the same thing with AI now.
Yep.
Because like Amazon and those guys, they're actually investing in their own nuclear reactors because those systems need such a lot of energy.
Completely,
electricity.
Yeah. No, it's amazing.
Exactly the same.
Look, one of the reasons I flew to Atlanta off the record, on the record publicly, anyway, but one of the reasons I flew to Atlanta was one of the big companies, the FANGs, I won't mention them, but literally you can choose between Microsoft, Amazon, and them, Facebook, had a data center in Atlanta, and the partners that we want to partner with are looking for a 10 million allocation in it, and but they're still waiting for the funding from BlackRock, and so they didn't want to like say yay or nay as to whether it's going ahead or not. But I mean, for me, if I could invest in Atlanta, one of the biggest and best cities in America, with a FANG as a tenant in a data center with partners that have been doing a long time and BlackRock funding, yeah, $10 million wouldn't be hard. In fact, I think we'd have a problem in terms of who would want to participate. ETFs, stock market, structured notes. Anyone know what a structured note is here? Yeah, I know Judy does. So again, I didn't know what a structured note was, and I'll share my screen just very quickly here because this is going to piss you off, and it should. So let me go here. So if I go here, where have I got it? Yeah, here it was. So in 2019, a guy called Chad came to me. He said, Scott, I've been investing in structured notes for the last 5 years, and it's seriously like doing well. It's outperforming a lot of my other investments. And why don't you, like you've taken medical buildings and fractionalized them, why don't you do the same thing for structured notes? So I'm like, dude, what is a structured note? So just for the record, I was exactly the same as you in 2019. And he goes, no, it's simple. When the banks need money, they basically provide a return to you and me of 4 to 8%, like at retail level. And if they package the debt up, they tend to pay like an 8 to 10% return. But if you play at the institutional level, they provide a 10 to 15% return. And I'm not talking in rands, I'm talking in dollars, pounds, and euros. And I was like, well, what does institutional mean? And he was like, you need more than $2 million in cash. So when he started that was 2019, 5 years ago, so it would have been 2014. You needed $2 million to invest in a structured note, which is why none of us know about it, because most of us don't have $2 million lying around for one opportunity. Does that make sense? So, and when I looked at this, it was like wow, so there's like a whole game going on here, there's a whole party that we haven't been invited to, which kind of pissed me off, and hopefully pisses you off. But so anyway, what we did with him was we fractionalized structured notes so that people could participate in structured notes. Gold and silver, private equity, venture capital, and crypto. So those are the 15 that we focus on.
So the structured notes, is that basically with a bank?
Yes. Yeah.
So it's a trusted partner. So
No, so it's like the big, so you only work with like A+ accredited banks, etc. I don't know if you want to talk about it, Judy. I know you've done a few of them. I'm just, you don't have to, I'm putting you on the spot, but.
So I've been doing it for about 2 years, but I mean, the money is then funded through, so if you've got like an international net bank account, as an example, you can then buy into structured notes from there. Or, I mean, it goes to very solid institutions.
yeah.
But I think the most important thing is that, and to be fair, even the banks now, as Judy just mentioned, are starting to democratize it. But you used to, literally, as Chad said, you had to start with $2 million, like 10 years ago. And what I find really interesting here, around structured notes specifically, is that none of us have even been told about it, so we didn't even know we wanted it, let alone were able to participate in it, if that makes sense, And you sort of ask yourself why. But what I find interesting with these structured notes is that when I sent an email out to our top 100 investors, so I was a bit embarrassed. Like I didn't want to be embarrassed with these structured note things. So I sent it out to top 100 investors, and I said, how many of you are investing in structured notes? Remember, I didn't know anything about them in 2019, so I was asking others. 83 people came back to me and said, we're investing in structured notes out of 100. I was like, what? Like, why have I not been invited to this party? Like, and then one gentleman, came back to me and said, no, it's been his best performing asset for the last 10 years. So I was just like, wow. Anyway.
Does that come back to private equity?
Yes and no. Yes and no.
Information.
Yeah, the right information, yeah. But in simple terms, it's actually just being invited to the party. I don't know how to say it any other way. Like, it's having the right partners to be able to get access to it. There's also, just to be clear, none of these assets that I've got on the screen, there's no such thing as all the assets in that space are good. Like, there's bad structured notes, there's good structured notes, there's bad partners. So please don't just run out here and like, structured note, Google, I'm investing. Like, that's not what I'm saying, okay? Because remember, right information, right partners. Does that make sense?
Yeah, and again, just talking to the diversity of that. So it's like, you don't go out and put all your money into one structured note, because all the notes are structured differently, so you just spread out.
And they don't all work. Like we've invested, and I've invested in some, and that they don't all work. So back to diversification in terms of that process. So just in terms of this, I mean, something that we've been working through at a mastermind level, but basically in simple terms, if you go here and you take the assets, every single one of the assets that I've just mentioned, we've actually gone through over the last 2 years, and we've literally gone and found a partner that I know or someone I respect that has specialized and been doing it for at least 20 years in every one of these assets. So I don't mean Harvard professors, I'm not interested in them, I'm interested in people that are actually doing it. And there's three things that are important. One is they can teach you how it works. Two is they can tell you the pitfalls and because they're actually doing it. And three is they can actually offer us opportunities to partner with them. Does that make sense? So that's what asset class mastery is in terms of all those things. Right. So, and I'll talk later about what the Wealth Hackers is about and the fact that you've actually got access to that. So this is one of those moments where I want to share this interview with you. So before I share it with you, because this will sum up everything I've been trying to teach you. Because this guy, Gary Sachs, is a developer in London, and he's going to explain to you the principles. I know you guys have actually seen Gary before, but he's going to explain to you the principles of investing in London, but just doing it at a whole different level to what we've all been used to. And as much as this video, I hope you can hear it clearly, but I highly recommend that we watch this video. And if you're listening to it, even if you're listening to it the second time, my strong recommendation is listen to all the principles that we've just learned for the last couple of hours in what he's sharing, but in real life. Is that fair?
Yes.
Okay. So I'm going to just sit there as well in terms of the process. So let us share. Gary, it's wonderful to have you online. Thanks for jumping on. It's always a privilege and a pleasure to learn from people that are on the ground doing it. I always joke with people, we could bring in Harvard University professors and London Business School economics professors, and they tell us all the rhetoric about what's happening in the market, or we could do it with someone that owns hundreds of millions of pounds, has developed billions of pounds, and probably has a better pulse on what's happening in the market. So do me a favor, give us the précis version of your story, how you got to London, and how you ended up being one of the biggest developers in London.
Not one of the biggest, but we've done okay. So I left South Africa in 1987 when I was 2. No, I'm kidding. I finished university. I went to Wits, came to England, actually started a little furniture shop, and kind of instead of waiting for customers to come in, I went out looking to all the estate agents. Furniture. And just a little bit of history of you own the furniture. So in other words, if the tenant owned the furniture, it was difficult to get them out because their goods and chattels were there. So I kind of transitioned from there to kind of being in the early 90s, was a bit of a property boom. And slowly but surely I started buying a flat here and a flat there and turning them and et cetera, and selling them. Until that went into developments, and we'd buy a whole development, as you talk about, but we didn't hold them. We didn't have the capital to hold, so we kind of flipped them. It was much easier in those days in terms of getting mortgages, etc. And then we kind of transitioned into saying, you know what, why are we selling this stuff? Can we not keep it? And most of the time we've used our own capital and made it sweat and built up a business that today we are holding nearly 1,000 units, with another 300 in the pipeline. And really the basis of this is, I'm sure a lot of you on the call know Natie Kirsch, and in 2009, it was impossible to get debt. And we had a development going up just to the east of Canary Wharf at the Excel Centre where the cable car is. And Natie funded me, and he said to me at the time, he said, Gary, he said, I'll go into this deal. He said, we've checked you out. We think you're honest, etc. He said, but he said, I don't know how clever you are, but even stupid people can make money in property. He said, just don't sell it. So and that's very true.
Just repeat it there. Sorry, because I know you well, and you drop these little gems in and people miss them. So just remind everyone what you just said there from one of the wealthiest people in the world.
He said to me, he said, Gary, I'm not worried about doing this deal with you because even stupid people can make money in property, just don't sell it. Which is great. You have to generate capital to keep on building. So, you can get to a point where the market gives you a lot of luck, or you can create equity by, for example, planning plays where you buy a piece of land and you get a planning permission, etc. It's just the higher risk stuff that creates equity. And then you've got imputed equity, and that's how we've done it up to now. And in fact, now we're kind of looking at external capital to come in and to fund us. And that ultimately is where we're going. So you have to understand there's been a transition in England. England's famous for saying, your house is your castle. And that's always been, people always trying to buy their own property. Just to give you an idea, in England, home ownership sits at about 65% of the population, which is enormous. That is absolutely enormous. But what's happened, and it's happened in the world, is as costs have gone up and as prices have gone up, it becomes more and more difficult to buy properties. It was easy up to the financial crash in 2007 because credit was available. As credit tightened up, it became very, very difficult to buy property. So there's been a transition to rental property. Now, that really comes down to the credit markets, because if you think about it, rent is the ultimate form of credit. Okay, so, if you go back 60, 70 years ago, the first consumer credit was really on cars. And that was because the car manufacturers making a huge margin. How do they get more cars sold? Is they offer credit. Okay, so and as long as and then they're actually making money on both sides. They're making money on the margins of the cars and on the credit. So what's happened in England is as prices have gone up, credit and credit has tightened up, the rental market has increased. Plus, I think it's included as a general world position of more of a nomad generation where people want to be flexible, want to move. I would guess that out of choice, people would prefer to be homeowners, but they justify being rentals, having a rental being in a rental because they kind of think it's kind of trendy, etc. And you can kind of get more value. What you don't have to do is invest in a massive deposit. So actually, over a life cycle of someone that is renting on a cash flow basis, it probably works. You know, if you offset the additional rent you're paying to what it might cost you on a mortgage, and you take the cash flow of the deposit, it's probably about break even. But what that's created is it's changed the rental market in the UK quite dramatically. So from moving from single, maybe a portfolio of 4 or 5 units, as people see as a pension for themselves, which, as you alluded before, starts becoming a nuisance to run. And that's mainly because if you have a portfolio of 5 and one tenant doesn't pay rent, you've got a 20% hit on your portfolio.
Well, even worse, most international investors have a portfolio of 1, and then if that tenant doesn't
correct.
pay,
Correct. So Scott, if you go back a few years, we kind of pioneered rental guarantees.
Yeah.
And the reason we did rental guarantees was not so much and this is, by the way, is when we were selling stock. And the reason we did rental guarantees was not so much to get better prices on our properties. It was to give the confidence, okay, to buyers that they knew their cash flow was secure. And so if you think about it, we had a development of 100 units, and Joe Bloggs bought 1 unit, and Dave Smith bought a 2nd unit. One of them would rent out first, and one of them would rent out second. One of them may have a tenant paying or not, etc. So if you do that over 100 and you consolidate that on, say, a rental guarantee position, that risk is reduced dramatically. Okay, so and reducing the risk, and what you really want is investment in property. You've got to understand property is a long-term investment. If you make money on property in the short term, it's because you're lucky with the market, and you can't predict that. You have to actually be lucky. You can take certain factors, which is what we're doing, and kind of use those factors to your advantage. So just for example, like we're noticing now, there's a huge lack of supply. So one can turn around and say, well, if you look at a macroeconomic position.
Well, if you don't mind, I'm actually just going to chuck up a slide of yours from when you presented in August. Just while you're talking about this, just so people can actually see what you're talking about.
Oh, okay, fantastic. Okay, so we've kind of adopted a kind of a macro policy on the basis that you've got to look at 10, 15 years on property to really get your income. Otherwise, you create a market risk. And we kind of saying, well, use what we understand to reduce that risk. We're all about risk reduction on the basis that even stupid people can make money in property, just don't sell it over the long term. Okay, and don't get me wrong, if we get offers on properties that are fantastic, we will sell, but our preference is not to. And also, by the way, you reduce a lot of frictional costs, but I'll come back to that. So we take the macro philosophy on property and say, well, demand is restricted. So if you think about it, what we've gone through since 2007, we had a financial crash. The markets really dipped, but they came back quite strongly because there was a huge wedge of cash waiting for a dip market. And we had a good run between, say, 2012 and 2016. We kind of then started tightening up. Then COVID came, reduced construction. No new developments were really started during COVID. We finished a 700-unit development throughout the period of COVID. So we were very fortunate. Cost increases went up dramatically. So viabilities that developers had done stopped working. We then moved into this high interest rate environment. And for those of a similar age to me, which probably not that many of you there, but I lived in South Africa at one stage with 25% interest rates. So the generation that exists now is very used to low interest rates. I don't believe interest rates are going to drop for another 2-3 years. And I don't think we'll see for a long time that 1-2% positions. So that has dramatically stopped supply. It's particularly in London. And by the way, Scott, as you know, we're London-centric. Okay?
Yeah, well, I was about to pivot. Once you finished on the fundamentals of supply and demand, I was actually going to pivot to this one of why London, because again, it's one of the capital cities of the world, but I'll let you talk about it. But ultimately, I don't think there's many investors that don't want at some point say they own a piece of London.
Yeah, look, the benefit of London is the stability of the legal system, okay, or of England as a macro. As a micro, everybody really wants to be in London and England. If you look at the demographics of the country, there's this huge kind of swathe up north, etc., and there's this kind of leveling up policy. But the truth is, people live out of London on the whole, in places like Birmingham or Manchester, because they can't afford London. And what you're finding is London is equalizing with those areas, because there's been a bit of a boom in Birmingham, Manchester. But what you find is in a down market, and that's how we plan. We plan for a down market. So if we can't make something work in the bad times, we don't want it. Okay, so and so London is pretty strong, and the shortage in London is dire. So just to give you an idea, London needs about 60 or 70,000 new units per annum. And I think like the average over the last 5-6 years is probably 18, maybe 20,000. So it's created a real shortage. That's when Scott was, you talk about co-living. So co-living is happening. There's what can happen is you can get smaller units. So what happens, you get like a unit going, an average unit, say 650 square foot, 700 square foot becomes 300 square foot. The only problem with a unit like that is you can only sell it for the income. You can't get any capital growth because you can't split it. So you have to sell it as a building. What we've opted to go for is a mixture between the two. So we are taking regular blocks, which can be split up, but consolidating them. And the theory behind that, having dealt with the macro side of why we're doing it, the theory is, how do we reduce frictional costs? Okay, so when you're a developer, you're going to develop, and if you take your cost, the general margin, profit margin for a developer is between 20 and 10%. Okay, so let's just talk, say, 15% profit on the gross development value, the GDV of the development. So as a business, if we can be vertically integrated, that 15% margin is we keeping. Now you take out the frictional costs. We don't have sales costs. That's going to cost the developer 5% of any development. We don't have further stamp duties, okay, to hold the stock. So if I sold an individual property to an individual investor, they're going to be paying me my 15%. They're going to be paying 5% of the cost that I've had added on for sales costs. They're going to be paying stamp duties. You know, it doesn't take you long to get to 18%. And then when you take the margins at 18%, that's quite a big difference. We also in an environment, obviously, where we've got increasing costs, okay, and a limited land supply. So for anybody that understands basic economics, sorry, if you don't mind, I'm just going to close the door because my dogs are going crazy. Just bear with me.
No problem. So just a couple of things to simplify what Gary's saying. In simple terms, when he's talking about cutting the friction costs, what he's saying is just cutting out the middlemen. And if you remember where I showed you the value chain of real estate, I said you could be investing at the end, which is what Gary's just saying, with all these costs all the way along, and that dilutes your return. That's why you never get out of the middle class, because your returns are middle class returns. Or you can go up the value chain, cut out all the middlemen, and that's exactly what Gary's talking about.
And of course, by the way, Scott, you're reducing the risk, as I said before, because you've got a development of 100 units, okay, and you're going to have a small percentage of bad debts. I think our non-payers and our voids run at about 1.5 or 2%, which is very low, very, very low. So we're running, as you know, we actually have just sold it, but we owned an estate agency, which we started from scratch called Life Residential, where we manage the properties. We sold it last week, actually, but we were running 5,000 properties in London. And I think our voids were like 45. You know, it was unbelievable. So, you know, everything is kind of brewing to make a really good cup of coffee in the residential market in London. Okay, so what you're finding is there's a lot of capital coming in for what they call build to rent, BTR, so kind of professional landlords. What that's done is it's increased the quality of the properties to some degree, but it's also increased the prices, because what happens is now you've got commercial competition. So I'm building a building, I need to put in a bloody nice gym, I need to make a community that people want to live. So it's all about customer retention. And suddenly, instead of us being a landlord, we're actually we're a business with customers. So we don't have tenants, we have customers. and we treat our customers like hotel guests. Of course, that's got slight increase in costs, but the relative cost increase is far less than the relative rent increase we can get, because people feel part of a community, they feel valued, etc. And and that's kind of the direction that we have gone and that we are going in. Okay, so we're trying to, and then the risk profile of the development, of course, is what you do. Do you buy a piece of land and take the risk of getting planning? And you must understand, when you do that, if you don't get the planning, you've kind of lost your money. You've got a mini field. Okay, if you can get that margin, that's how you make your most margin. So, you know, it's a risk return. The development risk we don't really see as a risk, because we tend to close our contracts in terms of the construction, etc. So just to give an example, through COVID, okay, we built, as I said, we built the tallest tower in West London, 57 stories, 700 units, and that was constructed through COVID. And believe it or not, our entire cladding came from Wuhan. Okay, so you can imagine our kind of blood pressure when COVID started, but we closed the contract with the contractor, so we had zero cost increases. In fact, we agreed to pay, I think, on a £200 million contract, we agreed to pay $1.5 million, and that was shipping costs, because shipping containers went up hugely during COVID, and so we agreed to pay some of the costs. And that was just a gesture of goodwill because of the amount of business we do with the contractor. And the Chinese cladding company also took some of the hit. So we kind of reduced that risk. And so the development risk we're quite comfortable with. We're super comfortable with the rental risk, because the supply and demand, it's going to take, I don't think it's soluble, actually, or solvable, actually, is the word. It will take 20 years at London at full capacity to build, to catch up, to actually provide the stock. The planning system in England is so bureaucratic and so difficult to navigate. And just give you an example, when I say about costs and difficulty of planning and restriction of demand, as you know, very sadly, there was the fire in London at Grenfell Tower. Now, the fire at Grenfell happened. It was a perfect storm. The building had bad cladding put on, it had no fire sprinkler system, etc., etc. So if you compare that building to one of our buildings, completely different. It's chalk and cheese, right? So we have full fire. In fact, we have the highest possible fire rating in our buildings. But what, in their wisdom, they decided to do was to say to anybody building a tower, and it went from 18 meters, from 30 meters and above down to 18 meters. Now, think about 18 meters. That's not that tall a building. That's like kind of, I don't know, 7 stories, 6, 7 stories. And they said, right, you have to have a second means of escape, a second staircase. Now, the rules in a tall building from a fire perspective is stay where you are, because you've got a fire system that works and that functions individually in every single room in our building. So obviously they kind of cracked a nut with a sledgehammer and decided to put 2 staircases. Now think about what that happens in a building. You've just taken out 10% of your usable space, which increases the costs. So you have a situation where a lot of developments aren't viable, and a lot of architects have had to go back to the drawing board and redraw up. So that's just another addition to the restriction on supply. So when you look at it like that and you say, okay, we've taken out we understand the development risk, we understand the rental risk, we understand about taking the frictional costs, you can start working to getting a fairly decent return. Now, the cash and cash return starts becoming damn close to what the banks are paying now. Okay, of course it's not liquid, but it's a cash and cash return. And I keep saying, I have friends that come to me and say, you know, you've done okay in the property business, can we buy a flat for our kids, etc. And I always say to them, I say, you have to understand, I'll sell you the flat, I'll give you the biggest discount I can, but you have to promise me, okay, you're going to keep it for at least 10 to 15 years. And I say to them always, and just to be sure that there's no misunderstanding, I'll give you a guaranteed buyback in 15 years at the cost you're paying today. So you cannot lose money. Okay, the absolute number. Of course, you're going to lose the income. but you cannot lose money because that's how confident we are in terms of the prices going up. And you just have to look, you know, when I come back to South Africa, I just think of a place like Shelley Beach, where my parents had a timeshare in 1980. Say 3, there was nothing there. There was a row of townhouses on the beach. Now there's a whole city. Okay, and that's like over a period. And the same is happening in London. You might be able to show a couple of the slides of what I'm talking about, Scott, about the regeneration.
So just before we go to regeneration, Gary, I want to go there. But just before we go there, there's a question from Stephen, and I think it sort of sums up with this slide I wanted to show. So when you're an international investor, the first thing you get offered often is Birmingham and Manchester and Liverpool, and there's lots of students and they need lots of student accommodation, and developers kind of sell to them. And I mean, I've heard this story. You and I have been doing this nearly 20 years together, and I've heard this story so many times, and I'm virtually almost yet to find people that make money doing this. I'll never forget in Manchester where 100 South Africans bought, you know, student accommodation, but it was 20 miles. I mean, that's like 36 kilometers from university. And when I was at university, trust me, I didn't want to live 36 kilometers from campus. Like, and needless to say, they couldn't rent it out. Like, you know what I mean? So these things all sound a hell of a good on paper, and then you have real life happening. And I just want to kind of reiterate, I've got a question and I've got a comment and a question for you quickly before we go to the regeneration. This for me is the difference between what I'm going to call that mom and pop investing, which is where I can't afford London. So I tell you what, I'm going to go to Liverpool or Manchester and I'm going to buy an old house and I'm supposedly going to renovate it long distance, by the way, which is now impossible. Then I'm going to manage it. Then I've got one tenant with one, you know, management agent, hopefully going to get it. And there's all these risks. Or I could invest with a partner that literally is building the development, is owning the development alongside me, is managing the development and cutting out all the middlemen. And that just, I want to try and explain to people, that's the difference between what I call mom and pop investing and institutional investing, which is what Gary's trying to explain. I don't know, Gary, if you've got any comments on that before we move to the regeneration.
Well, just reading Steve's question. So Steve, you're quite correct. There's been a huge flood of capital into the student market here. And it kind of defies belief, really, with the amount of quantity that's happening. But what you find is that people jump on a bandwagon, and eventually there'll be oversupply. But people doing that are competing with funds. You've got massive American funds. You've got massive university endowments that are buying these properties, and it's difficult to compete with them. So, yes, you're getting a return. How do the capital returns on a student development? Here's a very subtle point you have to understand, okay? The returns on a student development are purely based on income, okay? So if, let's just say, for example, you've got income at 5%, you've invested £1 million, right? You've got income at 5%, so you've got 50 grand coming off your investment. That money is valued purely at a multiple of an investment. So if the market and the cap rates on student accommodation is, say, 4%, you'll get a multiple of 25 on your income. Okay, and if interest rates go up, that will reduce. Okay, you might be expected to get 6%, and then you've got a multiple of 15.5, whatever the case is. Okay, so on residential property, you have the income. The value you can also sell because of the build to rent market. You can also sell on the cap rates. And by the way, if you look at any of the cap rates in the UK, residential property is the best cap rate and the most stable cap rate, right through COVID, right through running between, at one stage, 3.25 to now it's sitting at 4, whereas like the equivalent commercial is sitting at a cap rate of 6%. Okay, so the multiples are much more. But if you split up that building, you can also get the capital growth. Now you're talking about price per square foot. Okay, so income is generally based not on price per square foot. It's based on the market, etc. Price per square foot often has no correlation. In a buyer's market, has no correlation. I mean, I've been in an exhibition in Hong Kong when we, 20 years ago, where we'd go in and we started on a Friday selling properties at £650 a square foot, and by Sunday we're selling at £800 a square foot. Okay, which is like ridiculous. So that is the one fundamental understanding of what we do in terms of rental. Okay, so your exit and your IRRs and exit can be much, much higher than say what a student ultimately can be. Okay, a student accommodation. Very stable, great business, and there's been a huge surge. If you just look at the planning applications, people are planning a student and co-living, but it's really simple. Why? Because they're smaller units, and you're going to get higher income on a smaller unit. You know, you're going to get relatively more on a 1-bed flat as opposed to a 2-bed flat from a cost perspective. Okay, but how do you sell that? You can only sell it based on the income. So you're not getting involved in property, you're getting involved in capital markets. Okay, and the people that should really get involved in capital markets are banks, funds that deal in money. And for the individual investor, you're not really dealing in money. You know, you're not saying, oh, I've got £50 here and tomorrow I'm going to invest it here and then I'm going to put it there, etc. You have to look at a long-term strategy. Our strategy actually is so simple and so old-fashioned, but it works. In fact, I had a guy I know, a big agent in London, said, you know, Gary, I've known you for years. He says, you're one of the only guys that I know is still doing the same thing you were doing 25, 30 years ago. But, you know, it's kind of old-fashioned landlord and tenant, but do it in a much better way. I recommend a really good book, and the philosophy that we look at from a tenant perspective is the guy that started Four Seasons Hotel, Isidore Shaw. And he has a great biography, and where he says, put the customer first and foremost, okay, and everything else will follow. Okay, so, sorry, Scott, and one other thing that we do is we tend to fix our interest rates. Okay, so in the good times, we kind of fix them. In the bad times, we let them float. Risk reduction, that's all we do, risk reduction. We don't expect to make massive money, but we will, when the markets boom, we will make a lot of money. But we make very solid returns.
A couple of comments there. You've just taken people from a you know, school level to an honors degree to a master's to a PhD talking about cap rates and everything. So, you know, I'm sure for
Gray
some
hair,
like went straight over their heads. But my point being is that it's that type of stuff where not only in the VIP, I'll go into a lot more detail if people want to understand it, plus wealth going global. Gary, I want to come back to the fundamentals. And one of the things that I've learned from you and been part of with you is focusing on regeneration areas. They talk in property, location, location, location. But equally, they say in property, try and buy property with a twist. So talk to us a little bit about just, you know, and I can put up the slides for you quickly. You know, I don't expect people to be able to read all the slides, etc. But the point being is that if you want to just talk to us a little bit about the fundamentals of regeneration, and then also why you're now in West London and what the opportunity is in West London.
Okay, so the reason I'm in regeneration is because I could never afford to buy stuff in established areas. Okay, I could never create value. Whereas in a regeneration area, you can kind of create value if you have the vision. And that's one of the things about my experience when I mentioned about Shelley Beach is when you leave somewhere and go back over a period, you can really see the growth. So if you go back to Sandton, for example, 30 years ago, there was nothing. And if you go there now, it's unbelievable, right? So,
well, you've got a good picture for.
Okay, so correct. So that's kind of on the left. On the left was kind of when I kind of came to England, and I kind of liked Canary Wharf because you could go and rent something in an established area, was a bit old, a bit damp, etc. And yet you could go to Canary Wharf and rent something that's fantastic. It goes back to how the customer feels. Okay, and then we admittedly we rode that. So, and East London, the history of East London was it was seriously bombed out during World War II, and people and so it created a great opportunity. The buildings were built to a large extent because in the first instance it failed. Why? Because the infrastructure wasn't there. They hadn't put the tube line in, etc., etc. It's ultimately done. It's unbelievable, the growth and the change. So we kind of looked at that, and we happened to be based in West London, and West London is going through a transition. And West London actually is a bit of a no-brainer because it's much closer to the center of London, okay, than East London. But we were given a gift in the fact that they decided to build, I don't know if you guys follow the UK news, but you would have heard a lot about HS2 and it being cancelled. So HS2 is the high-speed rail link, which they were doing between London, Birmingham and Manchester. And in fact, they've just cancelled. It's gone so much over cost that they've just cancelled the Birmingham to Manchester route. So we've ended up in a situation where we have the largest station. On the left is what were shunting yards. And now you can see on the right, and I could give you an updated photograph. It's ridiculous, the amount of construction. And so there's become a whole town centre. So we are in this location, we are by far the best connected position in London. So we are in zone 2. So imagine zone 1, zone 2, zone 3 of the tubes. Canary Wharf is zone 3. We're in zone 2, so we're much closer.
There's a map.
And,
just find your map. There's your map there, basically. Just to
yeah. So if you kind of point out where West London, White City, you go a little bit left, stop a little bit left there. Well, stop there. That White City, you may have heard of White City, a massive development, the largest shopping centre in London. And then you've got to the right Westminster, and then you've got Canary Wharf. But the point is, in West London, the infrastructure is there already because the Elizabeth line, which runs east to west, comes straight through there. And then you've got HS2 and the tube. So that's why they chose the location, because it's where all 3 transport facilities meet. And so the infrastructure is there already. So, and we kind of pioneers. If you're just looking at that picture that Scott has on the right-hand side, just to give you an idea, this picture is taken from the 57th floor of a building that we've built. And if you look at the end of the triangle, but to your left with your mouse, that's another one of our buildings being built. That's going to be ready in April. We have another one across the road. Investments I'm talking to Scott about getting involved in, which is up to a 3rd floor to be ready in about 18 months, 19 months time. Imagine in that triangle is going to be the largest single station in the whole of Europe, not in London, in the whole of Europe. Okay, so anybody coming from Birmingham will be ending up there. So you've got regeneration. And in fact, Scott, yesterday, you might well all know Ballymore. Ballymore, in my opinion, are the best developer in London. They create the best infrastructure. Well, just to the right of that development that I'm saying there, just if you go up, that, by the way, that big green area is called the Scrubs. It's like the 3rd biggest park in London. And if you go just slightly up from there, there's a bunch of brown buildings. There you go, left, right there. Ballymore has just announced they've done a deal with Sainsbury's. They're building 2,500 units there. Okay, so if you think about what's going to cost them to build, if you think about what our cost is because we're out the ground already, and you think about the change in the area, that growth could be huge. Okay, so here's this investment philosophy. Okay, so we're taking something which works today and giving you pretty good returns. That, by the way, what you're seeing is, if you look in the right corner, you can see the building before we built the area and what we built. That's a great sign of regeneration. And if you can have the vision to say, where, so Scott will tell you, a lot of people, when I started building that building, they said, you're crazy. Now they think I'm a miracle maker. So this picture that Scott has got up is we are built now. The 3 orange buildings in front is Imperial College. Okay, they've got planning permission, they're about to start building. So that whole area is going to transform. All that area that you can see behind is part of the HS2 redevelopment. That's all, and the station, it's all part of the HS2 redevelopment. So here's the investment, okay? We know, and we work on current rates, current rents versus current interest rates to make a return. You might not get the 6, 7, 8% return on cash and cash. You're probably going to get net 4.5% return cash and cash. But think about the massive growth between now and 15 years with the regeneration, where all of a sudden you're sort of in central London, because central London is going to move towards the west because of the density levels. So, and at that point in time, unlike student accommodation, you could choose to break up the building and sell individual units, and think of what the cap growth is. So over the period, the cap growth is there. And we all have to look historically, how did our parents buy a house for £10,000 in 1960 Footsat, okay, and then end up with a house that's worth £2 million today? How did that happen? in a relatively short space of time. So, you know, I think that it's quite a subtle understanding to say. So my view is, if you take property as a long-term investment, you buy efficiently through reduction of frictional costs, okay? You end up and you hold it. You just have to hold it. And over time, you can grow it. It will grow naturally through supply and demand, increasing population. Okay, as they say, God has closed the factory of land. He's not building any more land. Okay, he's closed that factory. So supply is going to be reduced. You're increasing costs, etc., etc. And then you've got the addition. Okay, you have the absolute addition of the regeneration factor. Just where my per square foot cost today is not going to show any relationship to the per square foot cost in the different place, a bit like a place like Sandton becoming from going from one price to another price over a certain number of years. And that's really the philosophy of the strategy. And as I say, we've always tried to do it ourselves and sweat our capital, but obviously you can't keep holding property without sweating capital unless you can get credit. So, and that's why we're looking to kind of consolidate and make a fund. This what you're looking at now, by the way, is our platform for rentals, etc. Okay.
I'm just sort of showing people because they call them trophy assets, you know, aspirational, whatever you want to call it. And it's like so many people, you know, Gary, even when you and I were doing this 15 years ago, it took a hell of a lot of money even to buy one apartment. And then you had to go set up an offshore structure and you had to get a mortgage and then you had to manage the property and the hassle and everything in between. And, you know, what I love with what you're saying and in simple terms is that in the past, you used to, you know, I would help work with you, but we would help someone buy an apartment and then they were kind of on their own, like go and own this apartment. Yeah, there'll be a management agent, whatever, but it's kind of yours. Nowadays, you can partner with you in the development. You're owning a piece of the building. I'm owning a piece of the building. You know, Joe Soap's owning a piece of the building and we're holding it for 5-10 years. And you've got a full management solution, cutting all the middlemen out, which obviously is increasing the return, reducing the risk. And, you know, when we exit, there's multiple exit strategies, whether it's selling them off individually or selling them to an institution or whatever. I mean, have I summed it up, you know, in simple terms for people?
Yeah. You know what? Can I give the bottom line? We're in the business not making money. We're in the business of not losing money. Okay, so we start off with the premise we don't want to lose our money. That's the first thing. So if we break even, we're happy. We know that we'll make money over the long term. It just depends how patient you're prepared to be. Okay, that's the fundamentals, right? So one of the biggest frictional costs now, of course, is finance. Okay, if I can be a cash builder and developer, okay, we probably pay 10% for our money just on the development side. So if you start stripping it back and you're cash and you've got a group of investors and you're building for cash, okay, the margins are enormous, okay, but over a longer period.
Yeah,
the IRRs become huge.
Well, look, I've squeezed more time out of you than I asked for. So you promised to give me 15-20 minutes, and Cheryl said, "How can I get in touch?" You know, Cheryl, between Gary and I, we're going to be putting an opportunity together. It's going to be on the Wealth Migrate platform. People will be able to invest directly. So just do me a quick favor. Just stand up quickly. Just stand up. Because I'm sure you all feel the same as me. It's hard to sit and watch a video for 35 minutes. So just stand up. Just rotate a little bit. Just get some energy. Just get some air in your system. So I warned you this morning that one of the biggest challenges I have is that I could give you that recording and hope that you go and watch it, okay? And I know you're not going to. Well, I could play the recording and... I want to... Okay. I can't hear. Oh, really? Okay. Yeah. Okay, no problem. Okay, well, I will share the recording, so don't worry about that. Thanks for that feedback. But I didn't want you to miss it because the insights are invaluable, you know, in terms of, and hopefully when you watch and listen to that, you now start to get the sense of what I talk about, the difference between mom and pop investing and institutional investing. Does that make sense, you know? Yeah. So I appreciate you sitting and watching the videos, and my recommendation maybe is even after lunch, let's like move around a little bit, because just in case there's other videos or anything that I want to share. Because I'm not going to, normally when I do it online, I actually share more videos. But for today, I want to manage the energy in the room, etc. But there's certain videos I have to share, because like that for me sums up literally everything I've tried to say to you, but in real life. Like, does that make sense? You know. So again, we all think a lot of our friends is like, oh, I want to own a London property. Cool. They run out. They go to we won't mention a name, estate agent exhibition here at the Santon Hotel, and they buy an apartment. I mean, everyone's done it. Like, does that make sense? You know, versus doing it that way. And I think you can hopefully see it. I'm actually flying to London in the first week of December, because I've been trying to put a deal together with Gary for the best part of a year, and it hasn't worked. And the reason being is that fractionalizing is not easy. Okay? Like when you're talking to someone that's been doing something for a long time, to teach them how to do it a different way is actually really hard. So concepts and principles, like I love it. Because like basically, I don't know if you heard it, but I said, or sorry, I didn't say, but like basically, he was the gentleman, so he's South African, but he was the gentleman that did furniture packs for the British developers. And then because he did furniture packs, he realized that everyone that needed a tenant needed a rental guarantee. Every investor wanted a rental guarantee. So he sold the furniture pack with a rental guarantee. Then he built a management company with like 5,000 units, managing all the tenants, okay? And then he was like, why am I giving this money away to the developers? Why don't I just become a developer? And like, literally, that was his logic. So what I said to him is, I said, Gary, trust me, fractionalizing units is the next furniture pack. Because I mean, he's quite well known in London as the person that literally revolutionized how to sell like new developments overseas. So you'd come to South Africa and they'd put on an event at the Santon Convention Centre, people would walk in and buy houses, you know, that's the way it worked. They'd get the furniture pack and everything. And so I'm flying to London because I've said to him, like, we just want to invest alongside you. We want to, you know, you're putting up a however many story building there. Let's invest, let's buy 10 apartments with you and own all, you know, and own a piece of them. Does that make sense? You know, the only problem is, at the moment that we haven't been able to solve, is that when we do it in commercial property, the partner on the grounds stands surety for the mortgage. So what that means is they get the debt, okay? And we got two options. We can either buy it cash, but then the returns aren't as good as if you've got some debt. But if we're getting debt, if you and I try and get the debt, it doesn't work. Trust me, we're overseas, it's expensive. Whereas if he gets the debt, he's going to get it like 2%. But now I've got to sit in front of him and try and explain how this all works, because via Zoom and stuff, it hasn't worked. So I just wanted to really share it with you, because hopefully it gives you a sense of what we, now that's one of 15. Remember we went through the 15 partners? I just wanted to give you a sense of the one that, in my opinion, most people already understand, which is, I want to invest overseas, I want to buy in London. Okay, cool. Well then what's the difference between the way we've always done it and everyone else we know has done it versus a different way of doing it? Does it make sense? Any questions or comments before I move on? I am conscious lunches at Hopper Swan, don't worry, I haven't forgotten. But I wanted to just any questions, comments, thoughts, I'll check you online if anyone's got anything as well. It's really important because everything I've tried to share with you today so far, from a theoretical perspective, Gary summed up in a real life example. Does that make sense? You know, so and I'm happy the recordings will make available so that people can watch it again as well. Because
when you say make it available, like
we'll put it in the resources.
Okay.
Yeah. So everything will be in that resource. Anything that we say we'll do is in that resources page to make life really easy for you.
We're in London. We're in West London. Are they doing this? Because I lived there for 5 years and I couldn't figure out where.
Yeah, it's I actually not. I'd have to bring up a tube map for you in terms of. But it's, as you said, it's literally right next to that new station that they built. But I can't. I mean, I always think in tube stations, and I'm not 100% sure which one it is. I'm assuming it's near Acton, but Acton's zone 3, so it's got to be further. I was there 9 years as well, so I know my way around. Okay, so any other comments, thoughts, questions? I can see Phil said great insights on how Gary de-risks the whole model and leverages enormously. So did you notice how he cuts out pieces of it all the way along? So again, did you hear what, I know I said it there as well, but did you hear the value chain of real estate? Where in the old days, like he would build the building and he would sell it to you. But there was 5% being paid to the estate agent, there's 5% being paid in stamp duty and whatever. And he's like, why don't we just cut all of that out and you just invest with me? Yeah? So can I tell you a funny story before I move on? So there's a guy called Ben, I'm not allowed to mention his surname. So I meet this guy about 2 years ago, and he's worth £500 million cash. His family's been doing property for 3 generations. His dad came, to England like 3 generations ago and started buying up buildings. Anyway, so they've got proper money, and they'll do nothing with bank debt. So £500 million worth of property cash. So I meet this guy, and he says, "Listen, and by the way, I've got no video of him because I tried to put a camera in his face. He was like, no ways, no one's going to know who I am, whatever." But I got a property tour with him. It was the most phenomenal tour. Like, he took me around literally central London. He was like, this and that, and I mean, it's amazing. And so I'm talking to him, and he says, I said, "Well, so what should we be investing in?" This, as I said, it's about 2 years ago. He says, "Residential." So I'm like, what does that mean? Because you must understand, I'm walking with this guy, and we own that building. It's like 40 stories high, and we own this and whatever. And he says residential. I was like, oh really? So why residential? He says, because residential is the most resilient asset class there is. And then he said, and what's really interesting is I've got a friend of mine that's a developer, and for 20, I don't know exactly how long, 25 years, he's been building and selling. But he's realized that the real money is in building and holding. And so I should put the two of you together because, you want to buy and invest, and he wants to buy and build and hold. Like, it kind of seems like a good synergy. So I said, please, that would be fantastic. He says, the guy is Gary Sachs. I was like, you're shitting me. Because I was selling Gary's properties in 2008. If you came here to an investment thing in Pretoria or Joburg or Cape Town or Durban, I was literally teaching people how to invest in London, and we were investing in Gary's company in 2007, 2008, 2009, whatever. So anyway, just a small world, how it all works. Okay, the same, and it'll be in the resources, the same thing with ETFs. I would really recommend, they probably won't have time tonight, but I'd really recommend, there's about an hour-long session from Ann Wilson. She's absolutely amazing on ETFs and how to understand the stock market and everything. So that'll be in the resources. We'll put Gary in there as well in terms of the process. Okay, let me just get rid of. Augustina said, "I want to listen over and over again." Yeah, so we'll put in the resources for you. And then Gary captured his target market with furniture packs and rental guarantees, and then has a large pool of buyers, which allows them to secure funding to build these huge properties. Correct. Okay, so who's feeling a bit overwhelmed? Be honest. I warned you. I did warn you that we were going on a fast journey. So as we pivot into lunch, I wanted to kind of share with you something that I'm kind of really excited about. And we'll talk more about this tomorrow with the Wealth Hackers and kind of what the Wealth Hackers is all about. But for me, like a lot of the stuff that I've already shown you, and I just want to give you peace of mind, we do have, and I'm not saying you should do it, but I'm saying if you want to do it, everything we've got is at a much deeper level. Does that make sense? So if you take everything I've just taken you through, so I've taken you through how to find the right countries, how to find the right currencies, how to find the right assets. If you take the iceberg, we've literally I've tried to give you the important stuff, but if you want to go deeper, there's actually like long modules on each, like a 2-hour module on each one of those. So I'm not saying you should, but for those people in the room that want substance, it's there. Is that fair? Yeah. In terms of the process. And what I want to share with you now, and this is where we have a bit of fun before Christmas. Before Christmas? Well, actually before Christmas as well, before lunch. Who'd like to have a bit of fun before lunch? Yes? No? No? Yeah? Okay, so how to build a globally diversified passive income simply and safely without making the mistakes that most people make by doing it themselves. So we've got this investor strategy sheet. This is the overall kind of way to do it. But Shane sat with me, my business partner, and he said, listen, Scott, the most important thing we need to do is help people earn passive income. And Derek, to be fair, you deserve the credit for this. As Michael Honey said, I'll be saying this in 20 years for the record. Like, I've never forgotten, like, all of our events is because of Michael Honey said, because we went on a buyer's trip and he had so much fun, and then he came back and he basically said to me, Scott, when are we doing lunch? I was like, no, dude, the buyer's trip was to buy property and that, now we're done. And he was like, no, but we had so much fun, we need to have a lunch. And then the lunch became weekends, and the weekends became shareholders and like everything, you know what I mean? And I always credit Michael for it. Well, it's the same for Derek, because Derek gave like just a talk when we were just having one of our catch-ups. And he just was so excited about the earning passive income, if that makes sense, you know. And so Shane sat and he said, listen, all of this stuff we're talking about is important. All this theory and practice and partners and whatever. But actually, what is the single most important thing? Is to get someone a result as quickly as possible. Does that make sense, you know? So we went up, I was actually up in Joburg about 3 weeks ago. We said, how could we do this? Like, how could we help someone earn a passive income in 30 days? Okay, now that's quite an aggressive task, okay? Considering that 10 years ago you had to fly to America, buy a house, set up a structure, everything in between. Okay, so what did we create? Well, it's effectively the passive income challenge where you can do it in 30 days. It's starting, like, it's getting momentum next week, and it's starting officially on the 18th. So what do? Achieve a passive income with expert guidance, step-by-step strategies, and community support. One thing that's really important here is it's not Scott and all the talking. It's Alex with just clear, do this, do this, do this, and do this. Okay, so it keeps it simple. Earn passive income by Christmas and enjoy the holidays with peace of mind, and secure a spot. So what's important is I'll share with you how to do this. And if you register by Monday, then you're going to get an extra bonus next week, okay, in terms of this process. So why do this? Well, firstly, you'll get a result in 30 days. So I'm a very strong believer that if you achieve something and you actually see that it's real, then it changes everything. Because now it's not theory, it's practice. Does it make sense, you know? The second reason is earn while you sleep. So the whole logic of, we've all heard this idea of passive income, but like, again, if you've owned a house, it ain't passive. So, like, what does it actually mean, and actually, you know, get it? The third is step-by-step guidance. So what we found is that we kind of just want to walk people and help them, like, right, this week do this, this week do this, this week do this, this week do this. So it's just simple and it's easy in terms of that process. And so what we're going to do is each week, it's not a big time commitment, but each week it's just do this. And then the next week, just do this. Don't worry about all Scott's talking, that's irrelevant. Just do this. You got the point. And then lastly, community and accountability. There's lots of science out there that you've got far better chance of doing in a group than you have of doing it on your own. So it's a bit of a, like, you set yourself up for success in terms of the process. So our goal is to achieve it within 30 days. As I said, we're starting passively on Monday and aggressively on the 18th. And ultimately to get people the result. This is how we're going to do it. There's more detail to it, but I'm not going to bore you today with it. But in simple terms, in the beginning, it'll be setting up your goal and joining the group. It'll be KYCing, so that's basically getting set up on the platform and setting up your wallet. Then it'll be funding your wallet and looking at investment opportunities. The step 4 is making your first investment. So you've effectively got step 1, step 2, step 3, step 4. Then you've got tracking your results and optimizing your strategy. And the last part, which is the fun part, is celebrating your results. Don't worry, in other rooms, people get super excited, obviously. In Victoria, I don't know, obviously speaking up off the cards or something, I don't know. Like, who's this challenge for? Aspiring investors, so people that are new and want to get going. It's for seasoned investors who want to explore new opportunities and strategies. And it's for busy professionals. So this is exactly for the people that are too busy, that want it quick, simple, do this, do this, do this, do this. Boom. Like, that's why we've decided I'm not the one doing this challenge. I'm not the one running it, because I talk too much. What are the resources you'll get? KYC and wallet setup, weekly webinars, community chat, certificates. I don't care about this, but it's amazing how many people care about the fact they get a certificate. Anyway, and then just advanced webinar, like, so just different, you know. So the whole idea with the weekly check-ins is for people just to be able to ask questions if they need. Does that make sense? You know? Milestones and incentives, so this is quite important. So milestone 1, KYC and wallet setup. Milestone 2, make your first investment. And milestone 3, track your income. So our whole logic is within 30 days is that you've gone full circle in terms of that process. Just some FAQs. I've never invested before, no problem. The challenge is beginner friendly and offers step-by-step guidance. How much money do I need to participate? Start with whatever you feel comfortable with. We'll provide options for small and large investments. And then what happens if I miss a webinar? All webinars will be recorded and shared with participants, so you won't miss anything. The value is that moment where, like, We've got to talk about how much money you need to pay to be part of the challenge. So if you look at the value, access to the webinar is $250, wallet setup, $99, access to the community, $200, access to investment optimization, $150, certificate, $79, peace of mind, how much is that worth to you? Smart investing, how much is that worth to you? If you put it all together, it's $776. And what's interesting to me is that our whole purpose is to empower everyone to invest like the top 1%. So we're not doing 776. We will be from next year doing 97. I'm not saying that passively. I'm telling you for a fact it'll be $97. And by the way, we spoke earlier about Russell Brunson. I will be copying Russell Brunson's strategy, which is that he ran challenges every month and he charged $97. And why? Because when people pay, they pay attention. Does it make sense? Okay. So, but to start off with, we're not charging $97. It's free. So between now and Christmas, it's free. Okay. And why we're super excited is because we just want people to get results. Now the question is, let's reverse engineer this, because you should always ask, what's in it for them?
Yes.
Why are we doing it for free? So the answer is because we want people to first get on the Wealth University community. So the more engagement and stuff we've got on the community, the better for everyone. So that's our first reason. So to get on the challenge, all you have to do is you literally go to the challenge. I'm sure Shane will put the link in the chat box for people. And you literally go to the university and you go to the community and you go down to here and it says join the passive income challenge. And all you have to do is go in here. We've got 317 people. You just have to write income. That's all you have to do. That's all you have to do to join. Okay? Now, for us, what we're doing, you might as well know, because this is the way I like to operate, transparency. Why are we doing it? We want you on the platform. Okay? But there's a second reason we want to do it, and that's because I want you to get results. So, ideally, we want people to refer their friends. It's free. So we're going into Christmas, why not let other people participate? Yes. They've got nothing to lose, other than a couple of hours to set it up, etc. So, ideally we would say, refer 3 friends. Secondly, when you get a result, we want people to know about it. So Trustpilot or something like that. Because what's important is that people are out there going, it sounds too good to be true. Cool. Look, here are people that have got it. Does it make sense? So, this is I don't know what you call it, but it's like a moral agreement, if you want to call it, as to why we're doing it for free. The other one that's, sorry, just by the way, I didn't say it on the right there. Russell Brunson says and we all know this, when people pay, they pay attention. So my greatest concern is making it free. By the way, we debated this for about 2 hours. Do we make it free or don't we? And because again, when it's free, people don't do it. I did a challenge now over the the Tour de France, where I did a push-up for every kilometer they rode in the Tour de France. And about 80 of us started the challenge. We ended up having to do about 3,400 push-ups in 21 days. And by the end, there were only 10 of us. And again, it was free. So people sign up, they say it's lacquer, but they don't do it. Like life hits them in the face, they don't do it, okay? So I'm being very, very clear that from our team perspective, we agreed to do the first one for free, to allow basically our closest community members, etc., to participate. But with the awareness that they get one chance. Well, this is the carrot and the stick. Next time, it's going to cost you, and I don't know how Shane's going to do this from a tech perspective, and I know he hates me for saying this, but somehow I want it to be that this time it costs you $97, and next time it costs you $497, and the next time it costs you $997, and after that we never want to talk to you again anyway. So I'm serious, because the point is, if there's no pain, you're not going to do it. And what do we want for you? I want you to get a result. You ain't going to get a result unless you do it. Is that fair? Yes. And then lastly is that, and again, the mastermind members will know what I'm talking about here. Why are we able to do this? Is the traditional property deal might take 3 months to close, and it takes time for the rental income to come in. But we launched a product in the last month or so on the platform, which is a debt opportunity in Austin, Texas. And there they pay monthly. So we were like, well, actually, now there's no risk, if that makes sense. So if you invest I know that you're going to get paid in 30 days. Does that make sense? So the only, I can't give you financial advice, and you can get set up and you can find your wallet and you can invest in all the deals if you want. But the one that's going to pay you within 30 days is that one. Does that make sense? You know, so don't come to me and say, I invested in that deal, didn't pay me. Well, toughies, you went in the wrong one. Yeah. Okay, so any questions around the passive income challenge? Because we're wrapping up for lunch now. Huh? Yay for lunch. You know, it's such an interesting thing. I've been doing events for 20 years, and actually it's fun to be back in a real room. But like, you actually need music and hype, and I'm going to call it Tony Robbins, like get everyone excited and whatever. Okay. And it's really difficult when you're sitting in a lecture hall with a little speaker that's the size of so, and it's weird because we're talking investments and wealth and everything, you know what I mean? So it's this combination, but I also acknowledge that we're humans and it's our energy. Does that make sense? You know? So just be aware of that is what, you know, I'm conscious of both in terms of that process. So anything on the passive income challenge? Any questions? It's just one of the deals, Austin Business Finance. Oh, okay. Yeah, it's one. I'll explain it to you after lunch. I can't remember if it's after lunch or tomorrow, but
bloody final.
Absolute bloody final. Exactly. If you don't do it this first time, and I really, I think actually, Derek, if you don't mind, I'm going to use this opportunity because you're here, and it's if you don't, can I share that little clip? Okay, because I tell you why this is exactly why we built the passive income challenge. Was when this happened. Shane was the one that said, guys, we got to help people just get to results. Oh, sorry, that was the wrong one.
Scott, I can do it for all my kids, eh?
Yeah.
Started building generations.
Christmas present, give them each some money, and so there you go.
Yeah.
Nice.
That's wonderful.
So money in the future.
The more the merrier.
Yeah. So let's finish off before we go to lunch. And I mean, there's two people that deserve credit for why the passive income challenge exists. The first one was Derek, and the second one was Shane that helped put it all together. But this what Derek said to us as a group is why we built the passive income challenge. And by the way, as you go to lunch, this is our wish for you.
Scott, can you remember when you were a little kid and it was Christmas morning and you opened your Christmas presents? Huh? Can you remember that? That's
well,
what I feel like.
I have a little kid, so I get reminded quite regularly at the moment.
I tell you what, amazing. And I only just got a few dollars back in my investments again. You know, it's the second payment that I got in that I've seen on my wallet, and it's money that I didn't have to slog for. I had to think for it, but I didn't have to slog for, and it's absolutely fantastic. It's just when you start seeing your money work for you, it's just an absolutely indescribable feeling. And as a farmer now, I've got a very specific goal, which says that I need to build alternate income streams so that the weather doesn't matter. Yes. Because that's you know, being a crop farmer, the weather matters very much, and particularly this past year. When your income for a year is only 30% of what your expenses will be, you're in a difficult position. And to be energized and as excited as what I am in that position is incredibly empowering. Thanks, Scott.
So Derek, I just wanted to say, like, thank you for the inspiration. Because really what happened from there was we went away for that work session, and literally Shane was like, after that session, and he was like, we're missing the trick here completely. We're running challenges and we're doing this and we're doing that and we're keeping people excited and we're teaching them. And he said, Shane literally said, you got Jill and Joe Slope and they're sleeping in bed and they want to invest in, let's call it a property, but it doesn't matter if it's property, private equity. And all they want to do is make money while they sleep. That's all they want, okay? And the problem is they come to us, they come on a challenge and they go on a workshop and they do Wealth Going Global and then they have to KYC and then, you know, blah, 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 and they don't get the result. And Shane literally went, how do we get someone from A to B as quickly as possible? And we internally came up with a thing which we're now going to call the blue dot. One day when I write a book, it'll be called the blue dot, which is literally internally, it's our little code language. How do we get someone from A to B as quickly as possible? Which is why the challenge was built. So that's our intention. It's our first one. So there's one other reason that it's free, and I'll be honest with you, is that if it's free, you can't complain. Because, no, but on a serious note, though, it's the first one. People need to understand it's the first one. So we've got an aggressive target of doing it in 30 days. We want to take people through, but we'll also be learning what works, what doesn't work. And then the other thing that's important is that some people, and Shane and I had this debate for a long time, oh, but I don't want to wait 30 days. No problem. You can do it in 3 days if you want. Like literally, I mean, you can sign up on the platform, you can get your KYC, you know, whatever. But from our experience, it takes a bit of time, and then you've got to fund your wallet, and so we don't want to set people up for failure. So if we did it in 7 days and you missed day 2, then people would be pissed off because they're behind target. Like, does that make sense? So our logic was just set people up for success. I'm on the big screen here. Sorry, I didn't see that. In terms of that process. Cool. So let's wrap up for lunch. I want to. Yeah.
I just need to say one or two things, but when you're done.
Okay. Let's just do the action steps quickly. So for silver, for this session, so fill in your top 5 countries, or copy mine. Fill in your top 5 currencies. Fill in your top 15 assets. So remember your sheet. I mean, again, ideally, I'd like you to walk away with this in principle, where you actually got an idea of what you're doing. Does that make sense? Yeah. If you don't know the answers, so be it. But I've, that's the intention. Watch Ann Wilson. So again, I'd recommend that, and for others, they want to watch Gary again as well. And then share one key takeaway. So just before we go to lunch, it's going to be the same process every time at the end of every module. What's a takeaway? And if you want to think it, write it down. I just like to take a bit of time. Trust me, this will be the most important couple of minutes of the entire day for you. What's the time? We're a little bit over. But just one key takeaway. And if you're online, you can type. Just think about it. If you want to chat to your partner, go for it. But it's really important that you have one key takeaway from the session.
Just stop. Just stop. I didn't take those.
So, Patricia, you want to invest in the Austin business opportunity today? Perfect. My wallet is already funded and verified, so you can literally go ahead. I'll share with you. I actually can't remember if I do it after lunch, but I'll share with you today or tomorrow, literally on the platform. But it's as simple as this. Just while everyone's doing their key takeaway. If I go here and I literally go to Wealth Migrate, and I go to invest, and I literally go sign in. So if you funded your wallet and you verified, I would literally go to the Austin Business Finance, this one here, and I would go invest. So I can look at all the details of the deal, etc. But I basically now just want to invest. I go invest, $10. I go continue. I digitally sign the agreement. I go agree. I go make investments. And there it's done. View portfolio, and you can see that I've invested in the Austin deal there. So for Patricia and everyone else, that's what we'll share after lunch in terms of the process. Okay, right. Just any key takeaways that anyone wants to share? It's lunchtime, but anything anyone wants to share, yeah?
With the right partner and the right knowledge, getting it done is easy.
Perfect, yeah, fantastic. Anything else from anyone? Yeah.
Don't mom and pop your property.
Exactly.
Yeah.
You'll be surprised. You'll be surprised how many conversations I have with recovering mom and pop addicts. That realised that they were hooked on the wrong track, basically, if that makes sense. Anyone else? Anything else? Yeah.
Yeah. So within the top 15 assets, pick and prioritize with data-backed decisions.
Perfect. Awesome. Coming from the engineer. Invest in data center, if you can find the partners, trust me, we're trying.
I'll do some research and see what they're doing.
Philip said take action and momentum. Jan said being made aware of structural notes. Gary said cut out the friction costs in property. I think that was everyone in terms of the thing. Okay, cool. Thank you for all the key takeaways. I hope you've written them down. And then lastly, there's a link here if you're interested to a risk tolerance questionnaire. By the way, we've evolved this a lot more now, and I'll explain it later this afternoon, where we've literally, with our family office, created the Enneagram and Wealth. So before we had that, a year ago, I would tell people to go there, and actually, there's a good point here, we must make a note here, Alex, because there's no real need to do that now, because if you've got your Enneagram, you wouldn't have to do that anymore.
You'd be understanding it.
Yeah. But ultimately, that comes down to how you manage risk in terms of your process.
I think, yeah, anyway, we rush time.
Yeah. So, there's the formula. That's how it all works. Diversify across countries, currencies, assets, partners, and time. It's about the right information and the right partners. The passive income challenge I have shared with you, it's your gift to us, but make sure you do it. As we move into module 3, it's how to build a diversified portfolio. And as Nelson Mandela said, money will not create success, the freedom to make it will. So, over to Alex, it's lunchtime. I just want to thank all of you. This is a deep privilege for me to share all this stuff. And thanks for, I found it really hard when I was watching Gary's presentation, because I'm watching energy and I'm managing energy, and I can manage it when I'm talking, but when I'm sitting in the back corner, it's really hard. I'm very grateful, because what we're actually going through is not easy stuff, you know, and in terms of the process, and I'm so far just very grateful for the energy in the room, so thank you very much.
Just quickly, in terms of logistics and operations, I've spoken to the lady at the reception/restaurant. The little hole in the wall there, that's for takeaways only. So when you go into the restaurant on the right-hand side, just please be aware that they're going to bring food up, but obviously they don't know who you are. So just look for whatever you ordered and then just, figure it out. Good luck. And then if you want some orders...
This sounds like a well-oiled machine. I mean, what could go wrong with that system?
Yeah, I'm good, but I'm just as good as I can get. But I'm sure we'll figure it out. Pardon?
The payments?
Yeah, and then payments will be at the counter there. So there's a lady, she'll be around, just look for the lady with the white shirt. Okay. And then if you would like to order for tomorrow, please speak to her, order it, pay it so that it's ready for you for tomorrow. I have mentioned everything to her, but she's going to handle logistics so that I don't have to.
Okay, thank you.
Cool, because I've got enough other things I have to worry about. Cool. Right,
okay, so just in terms of coming back, it's 1:45 now.
Yes.
My suggestion is we come back for 2:30. Is that cool?
Yes.
Yeah? So I think half an hour might be a bit tight.
Yes.
So we come back for 2:30. But do me a favor, we've got a really important session this afternoon. So if we can try start on time, it means we won't finish too late. Does that make sense? Okay. Is that cool? Anyway, thanks very much. I'll see you now. And to those of you online, 45 minutes basically. So I will, I'll put a counter down as well for you.
I'm just checking when you're going to send that.
I'm coming, Alex, if you just give me 2 minutes. Where must I find you guys?
In the boardroom inside.
Okay.
Nice to see you guys put a digital, 3D, yeah, retro, yeah, that's right with it. Yeah, I need my tablet. Just maybe, speak to the lady with the white shirt, and then she'll take it, so she'll, sorry about that, I should have thought about that. Okay, so let's go through some.
Shane, are you there?